Excuse me. Mhm. We are live. Good morning. Good morning. Good morning. Good morning. All right. So, ladies and gentlemen, we will now go over our long-term charts and get everything started. Quarterly is going to be super quick. Still inside bars, trying to test that top of that bullish engulfing, bullish outside bar. So just have to wait and see what that looks like. Monthly chart is still doing the same thing. It's inside of previous month's bar. So this is a potential ABC pattern to come back down after a downtrend. So we'll see if that's the case. And then on our weekly, as you can obviously see, it's in an uptrend, and it's been an up week this week. So we got to see how that works out. And then on our daily, same old, is hit that resistance area from late last year, earlier part of this year, came down, it's going back up and testing that area. So we're going to see what happens with that. And now we get to our intraday charts. I will go over this now because I've had some questions for those that come on and don't recognize what we're doing. So I'll go ahead and tell you. What we are doing is we trade a process called price flow analysis, where we literally look at multiple time frames and look at the correlation between price and volume. And then we take trades, attempting to take the trend within a trend trade on an intraday basis, where we can then load up and scale into our positions. You're not going to be able to scale into about 50, 60% of them, maybe. Because sometimes, it doesn't work the way that you want it to, because the market is going to do what the market's going to do, not necessarily what you want to do. It's those times when it does do exactly what you wanted to do, then that's when you are supposed to capitalize, much like we did on earlier part of this week. That being said, we have some indicators on the chart. We don't trade the indicators. So let me tell you how that works. The indicators confirm what we're seeing in price to give us a quick visual. Okay. And we use divergences, and we use long-term and short-term momentum along with moving averages. Besides that, that's really it. To get an in-depth view of exactly what we do, just send me an email of support at theprofitstalker.com, and I'll be happy to answer any of your questions and try to get you on the right track, so to speak. As far as everything goes, that's what the purpose of this channel is, not necessarily to teach here. We show you what we're doing here, and allow you to see what we're doing live. Because I know a lot of times people don't trade live, and they show after the fact videos and that kind of stuff. But we like to be live so that people can see exactly what's going on, without any pomp and circumstance or us kind of putting our own twist on it after the fact. It's in real time. So with that being said, we'll go ahead and get started for today. Ronald Jones, can you please give us the news for today?
All right, we had 8:30. We have 4 red folders, core CPI, two CPI folders, and unemployment claims.
Okay.
At 10:30, we have a yellow folder, natural gas storage. At 1:01, we have an orange folder, 30Y bond auction. And at 2:00, we have a yellow folder, federal budget balance.
Okay, cool. So I didn't hear you say anything. Did you say anything about an orange folder after?
Orange folder at 1:01 is 30Y bond auction.
Okay, cool. All right. Well, ladies and gentlemen, let's see what we have here. Oh, and by the way, I also had a question about the playing of the audiobooks during the times of when we're not talking. You know, I'm not big on just talking for the sake of talking. That's not what I do. So I try to add value to the group or to the channel by allowing you to hear audiobooks that aren't copyrighted. And you know, that's something that I kind of had to figure out. So I try to be able to play audiobooks that are worth it, that I listen to, that are not copyrighted, that I've purchased and play them online. So that's another thing that we try to do to be different, separate ourselves from uh, the general public, and then also allow you to create, or us to create value for you by being on the channel. So with that being said, that's what we got. Also, we're going to be playing a lot of classes that I've given now for people to come in. If you want to listen, you'll be able to listen to it while we're trading as well. So that's it for right now, everybody. Quentin, if you could go ahead and cue up that first part of how to read stock charts, and let's see what that sounds like to everybody. Can you hear me, Quentin? Okay, ladies and gentlemen.
Y'all hear me?
Reasons to take a trade.
Okay.
So we're going to go over 7.
I apologize, ladies and gentlemen. I was on mute. I have started the videos of how to read the stock market that you could listen to. And do you guys hear me?
I can hear you perfectly, Quentin.
Perfect. And you can hear the video, okay?
I heard it in the background temporarily when you first came back on.
Okay, I'll go ahead and play it again.
All right, cool. The things the market can do.
Mhm.
We're going to go over 2 reasons to take a trade. And then we may get into some more stuff just depending on what time frame we have. So what I'll do is I'm going to type up here in the box, and then I'll say today's session.
Is this something that I should actively take like physical notes on, or
You can, but it's going to be I'm going to let you know right now, everything's going to be on the screen. So you can take notes at your leisure, and you can kind of take notes as I'm giving it to you as well, because you'll see me type it in here. Seven things that you can do. To take a trip. And this literally is part 1. There's to the there are 3 parts to the lesson, and this is training session, and then we'll do another training session, and then we'll do another training session that'll be all the introductory training sessions that you'll need. But this is part 1, and you'll see it. Put it up here in the corner, and you'll see today's session. We're going to talk about the 7 things the market can do, and 2 of the 4 reasons to take a trade. Okay. All right. So one, the market can make a higher high, right? That's one. And I'm gonna show it to you on the chart too. Okay. So that's one. The market can make a higher high. Two, the market can make a higher low. Three, make it six, seven, it can make a reversal.
Okay.
Those are the 7 things the market can do. So I'll go with them again and then get into the interactive part of the trade. A higher low, a lower low, a lower high, a double top, a double bottom, a reversal. And as a bonus today, I'm going to talk about swing high highs. It did, didn't it? Swing high highs.
948, less than 15.
So we'll talk about swing highs, swing lows as well. So let's go over this portion first. See it? Right. So we're going to go over that right now. I'm going to make the screen a little bigger so that you can see exactly what I'm talking about. 1 second. Let me move these things over with. Let's say obviously. Make sure that you can see. All right. So let's talk about the higher high first. Right.
Mhm.
So if you look at, you pick any spot on here, but we're going to pick this one. We're going to pick, I'm going to make this, excuse me while I make this just a little, because I need to move this drawing so we can make sure we see everything. So now you see this bar right here, and I'm going to highlight it, right? This bar right here,
The green bar?
the green bar, right? You see the green bar, right? You see this bar right here has a, see the high of this green bar before it, right?
Mhm.
This green bar here is higher than that, right?
Right.
So that's what you call a higher high.
Okay.
Okay, so that's a high high. It's simple stuff, but trust me, when you simplify it,
Mhm.
it makes it easier to understand when it comes to reading the markets.
Right.
So you have this higher high here.
Mhm.
That bar is higher than that high, right? Now, this also has a higher low, because you see the low point on this bar previous to it has that low point. You see that?
Mm-hmm.
Okay, this bar here, that's highlighted in green,
Mm-hmm.
has a higher high and a higher low than the bar preceding it,
Mm-hmm.
right? So that's one phenomenon that it could do, a higher high and a higher low than the bar that's preceding it. Okay, so this bar here has a higher high and a higher low than this one. Now let's talk about the lower low and lower highs. You see this bar here, let's go to this red bar. You see this red bar here that I'm going to highlight it so that you can see it. You see that bar there?
Mm-hmm.
It has a lower low than this bar. Let me do that. Let me do it this way. It has a lower low, right? But this bar is low is here, and this bar is low is here, right? So this bar here also has a lower high because it didn't get any higher. So it has a lower low and a lower high than the bar that preceded. See that? Does that make sense?
Mm-hmm.
Is that easy to see?
Yes. Mm-hmm.
Okay. All right, cool. And I know this may seem a little elementary, but trust me, it gets very complicated very quickly.
Right.
So let's go and find, so we're going over the lower low and the lower high, right?
Mm-hmm.
So now let's see if we can find a double top and a double bottom. And let me see if I find one. Because those are harder to find. To be honest with you. So let's see what we can come up with. I don't see one yet. Hold on. I think we may have something. So let's go here. And let's go here. Perfect. Okay. So I'm going to draw a line. See this red bar here?
Mm-hmm.
And you go all the way across. See that red bar there? See,
Mm-hmm.
so I'm going to highlight these two red bars for you to see analysis. And let me go to my rectangle. This bar here has a high. See that?
Mm-hmm.
And this bar here, actually, there's a couple of them, but we'll highlight the one that I was talking about. That bar there has a high, right?
Mm-hmm.
But they're the same high. That's called a double top.
Okay, you're talking about the two red.
Bars, right? The bar there
Uh-huh.
and the bar right there. The two
Right.
red bars. So you're going to, that's a double, these are double tops. Okay. So that's when you look, when you're talking about double top, you're talking about two bars that are different that have the exact same height.
Mm.
Okay. So that's what you call a double top. A double top is nothing. You can say double, you can say two top, you can say, but it's a double top and they have the exact same height. Now, let's see if we can find a double bottom. That was, yeah, it took some doing to find that. So let me find a double bottom here. Well, I think it might be one right there. If I'm not mistaken, I could be off. So let's see. Oh, it's perfect. So there you have a double bottom. So you have right here on that green bar,
Mm-hmm.
and here on this green bar.
Mm-hmm.
I'll tell you, let me do it like that, and then let me move it there and move it here. Right?
Mm-hmm.
So that is what you call a double bottom.
Okay.
The first one we looked at was a double top here.
Mm-hmm.
This one here is a double bottom. And they have the same bottoms. I mean, this, You know, the price came down and hit the same point twice.
Hmm.
So I'm gonna ask a question, and you know you're not supposed to know the answer to this, but I'm just gonna see if you notice. Do you notice what happens at the double bottom and what happened at the double top? To price? Do you notice what happened to price at those 2 points?
No, I did not notice.
Okay, that's fine. They sometimes reverse. See how it hit that high, and
Mhm.
then it receded off of that high
Mm.
to the downside,
Mhm.
right?
Mhm.
And then this one here hit the hit the low, went up, came back down, hit this low, then she took off to the upside.
Mm.
It doesn't happen like that all the time, but a lot of times that's what happens in double bottoms and double tops. Okay. All right. So then the next thing we're going to talk about are the reversals. I'm going to get back to my station here, and I'm going to talk about there are 4 kinds of reversals. Okay. And I'm going to type them in here so that you can see them. And you can take notes as necessary. So let's see here. Type text. And then you have your 4 kinds of reversals are, as I revealed, make sure I can spell right. Okay, good. You have 1 ABC pattern. You have 2 1, 2, 3 pattern. You have 3 the 2B pattern. And you have 4 the 3-bar reversal. That's hashtag. I need to fix that. Okay, so then you have these here. You have 3-bar reversal. You have the ABC pattern, the 1, 2, 3 pattern. And let me move this so we can see it here. All right, so these are the kinds of reversals, and I'll give you a second to write that down. You have the ABC pattern, the 1, 2, 3 pattern, the 2B pattern, and the 3-bar reversal pattern. And we'll go over those patterns, and when you let me know that you have that written down and ready to go.
Oh, I'm ready. It's ready.
Okay, cool. So I'm going to move all over this chart because I have to find what we call the ABC pattern. So I have to get back to my time. Chart there across there. Okay, good. And then there, and then we're at November 2023. So, okay, cool. All right, there we go. November 2023. So what I'm going to do is look for an ABC pattern. And then let's look for a good. I know there's one in here. I want to make it clean. Okay, cool. That's good. That's good. That's good. Okay, so an ABC pattern happens after an uptrend, and it's not cool. So hold on, take that back. That is not a good one. I want to shoot it. I want to show you as good a one as I possibly can, and I think we have a winner. We do. I think we have a winner. We do. Okay. So the reason why I kept scrolling is because I wanted you to see exactly what one looked like. So I'm gonna ask a question, and I don't want you to overthink it because it's a really simple answer. So it's probably going to be the simplest thing that you're going to come up with. Uh, what kind of trend would you say this is?
Um,
Up or down trend? Let me ask you that.
oh, up.
It's an uptrend, right? It's because the market just continually moving up, right? So an ABC reversal gives you what we call, and I'll type in the box so you can see it. That's not do. Type text. Okay, so you have what we call an A, a B, B, and a C. So the ABC pattern, right,
Mhm.
has a higher low followed by a lower high, followed, and this is an uptrend. So ABC pattern uptrend has a higher low, lower high, then a higher low. Okay. And then what typically happens is the trend then resumes in its original direction and goes up.
So I'm sorry, could you say that again? For the ABC pattern, it has the lower high.
Okay, so it starts with a higher low. So I'm gonna type it out, right? So I'll type it out. It has a higher low,
Okay.
so you can see exactly. B. It has a lower high, and then it has a lower low. An ABC pattern has a higher low, lower high, and then a lower low. Okay. So, and then after that, it then start to resume in the direction it was originally going. Okay.
Mhm.
So that is what the ABC pattern does. Uh, and then we'll get to the 2B pattern, right? Because the 2B pattern happens off of the ABC pattern, or can happen off of the ABC pattern. So we have here, and the ABC pattern compares this higher low right here
Mhm.
and this lower low right here.
Mm.
Okay, so it compares those 2 points, and it becomes an ABC pattern once it breaks above the high of the bar here that broke the bar low here. So I'm going to repeat that again. The 2B pattern is complete when price breaks the high of the bar that broke the low. So this bar here broke the low of this bar here. So when price then comes back and breaks above this high, that ABC, I'm sorry, that 2B pattern is then complete. And now prices should resume to the upside. And I'm going to show it to you now. When price breaks the high of the bar that broke the low. So this bar here broke the low of this bar here. So when price then comes back and breaks above this high, that ABC, I'm sorry, that 2B pattern is then complete. And now prices should resume to the upside. And I'm going to show it to you in the opposite direction. go. And then what we have here is okay. So now we're gonna look for an ABC pattern to go down. I want to see if I can find one. Just give me 1 second here.
Mhm.
Need to find it. Down. And there we have it, right? I don't know what just happened. So let me see. Oh, I see what happened. I got mine. There we go. So we have a downtrend
Mhm.
here, right?
Mhm.
And then now we have again our ABC pattern, right?
Mhm.
So that would be, and I'll show you this too here. Yeah, you're. Let me get this type text. So then you have your A, B, and C pattern there, right? So you see now the ABC pattern going down has a lower high, higher low, higher high. You can write it down so you can see it, right? So it'll have a lower high, there, so you can see it. It'll have a higher low, and then it'll have a higher high. All right. So in this case, right,
Mhm.
the 2B pattern is very simple because all you're going to do is look for that high point
Mhm.
of that lower high. And then this is the bar that broke that high, right?
Mhm.
The 2B point is a breakdown below the low of the bar that broke the high.
Okay.
And let me move this here so you can see it. So it's the low of the bar that broke the high. And then once it does that, the downtrend, I have it drawn with the arrow, but I should have drawn it. I mean, with the line, you draw the arrow here. The downtrend at that point should resume, right? Should just continue down like such, right? Once it breaks this low. So this is the high. This is the bar that broke the high. Once price then comes and breaks it down below that point, then we're looking for the trend to resume to the downside. Okay. So those four, I'm sorry, that's two of the four reversals. We talked about the ABC pattern.
Mm.
We talked about the 2B pattern, both in an uptrend and a downtrend. Now, let's talk about the 3-bar reversal next. All right. The 3-bar reversal, we'll go to a different area on the chart so we don't. You do have that, right?
Mhm.
You have the bar. Okay, cool. So then the 3-bar reversal is, let me find a good one that I can show you that's easy to see. That's perfect. Okay. So a 3-bar reversal takes into account 3 bars. and we'll both look at a long and a short, okay? And what happens is I'm going to separate these charts out some
Mhm.
so that you can see them. And you can see, we're going to count them here. The 3-bar reversal counts for, and I'm looking for my tool to type my text. Okay. So we have 1 bar,
Mhm.
we have 2 bars, and then we have 3 bars. Okay.
Mhm.
The 1, 2, 3 reversal is when price then, when bar 3 gets above bar 1. And that is basically a 1, 2, 3 reversal. When you have 3 bars as such, and then you have the 3rd bar to get above the 1st bar's high. Does that make sense?
Mhm.
Okay, cool. So on to the next one. Now we'll look for a 3-bar reversal down. I think I see one. Let me make sure that there. That's really tough. That's really tough. Let me look on to the downside now. And that's not going to work. Okay, so let's just keep looking. Yeah, these are a lot of. Okay, come on. Now I know you. There we go. Okay. So a 3-bar reversal to the downside would be, this is bar 1. I'll type it in here. Second. So this is bar 1. This is bar 2. And then this is bar 3. And then once price then gets below, excuse me, when price gets below the low, of bar 3, your 1, 2, 3, 1, 2, 3 reversal is then intact and complete. Simple as that. All right.
Mhm.
All right. So now we've gone over the ABC reversal, the 1, 2, 3 reversal, the 2B reversal,
Mm.
and now we'll go over the 3-bar reversal. Okay. The 3-bar reversal looks just like a 1, 2, 3 reversal, except in this case, you have, now I use this because this is a perfect example right here. Let me give this example right there. That's perfect. So type text here, and then this is 1 bar. This is 2 bar. This is 3, and I apologize. Let me start over. That's a different variation of the 1, 2, 3 reversal. Let me do the 1, 2, 3 reversal like this. That's my apologies. I got ahead of myself. So let me stop. Scratch that.
Okay, so the other pattern that we just finished, that was the 1, 2, 3 pattern.
That was a 1, 2, 3. That was the 1, 2. That was the 3-bar reversal. The pattern here is the 3-bar reversal.
Okay, that one right there.
Yeah,
Okay.
this is the 3-bar reversal. 3-bar, 2-bar. This is the 3-bar. So it's a 3-bar reversal. A 1, 2, 3 pattern is I got ahead of myself.
Okay, so that's what we're doing now is the 1, 2, 3.
Is what we're doing now. So the 1, 2, 3 reversal is it's easy to see. Oh, that's it right there. Okay. A 1, 2, 3 reversal is when you have price going into a downtrend, or like if you're looking at a downtrend and then you're looking for it to have to reverse. So let's look at it here. Arrow, arrow, arrow. So you have this down trend, right?
Mm-hmm.
And then you have let me get my tools out. Type text. The 1, 2, 3 reversal is here is 1, 2, and 3. And that involves a series of bars that we call swing highs and swing lows. That is what I told you would be the bonus. So if you have a series of 2 or more bars going in an upward direction, right?
Mm-hmm.
And then a series of 2 or more bars going in a downward direction, like such.
Mm-hmm.
And then it doesn't break the low of 1. So you have 1, and then you have 2, because this then forms what you call a swing lower high. And we'll get into that in just a second. And then that lower high comes down and it doesn't break the lower number 1. If it turns back up, then you have a 1, 2, 3 reversal.
Okay.
So that's to the upside. Okay. And the swing is again 2 or more bars going in one direction. And then the swing down or swing low would be 2 or more bars going in a downward direction. Okay. So that's the 1, 2, 3 reversal to go up. So you have a downtrend, and then that downtrend is then interrupted by giving you a lower high, thinking it's going to continue, but it does not. Instead, it literally stops before it gets to number 1, and then turns back up and goes in the opposite direction. Mm-hmm. Okay, so that is the 1, 2, 3 up reversal. Now let's talk about the 1, 2, 3 down reversal. We got an uptrend, 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 and then you have that is a very deep. That's very deep. So let's keep looking. Let's keep looking. That is perfect. I think. Let's see. Yep, perfect. Okay, cool. So you have this high, right? So you have this at 1. Let me type a box in. You have that at 1. You have this at 2. And then you have here at 3. Okay. So you have 1, 2, 3. And this, the third high, is a lower high than the previous high, because if you look at here, just to show you here. There you go. And if you look at this high right there, price did not get above 1, right? Mm-hmm. It came down to 2. 2 more bars going down, so a swing low. 2 more bars going up, which is a swing high. But this swing high is lower than this high over here. When price then goes back to the downside, right there. When price then goes down here,
Mm-hmm.
and you have a series of red bars start to form, like so,
Mm-hmm.
and you know for a fact that is going to resume to the downside as it comes down here, right?
Mm-hmm.
So now we've gone over the 7 things the market can do.
Mm-hmm.
We've gone over the 4 kinds of reversals. Now let's go over the only 2 of the 4 reasons to take a trade, in my opinion, right? This is just the way that I trade. There are a few more ways that you can get in a trade, but I'm going to highly suggest you stick to these 4. You'll make a lot more money.
Okay.
So now let me get back to my November 2023 area, right?
Mm-hmm.
The next thing we're going to talk about is this right here, the swing higher low. So I'm going to get my line here. I'm going to draw it, right? I'm going to draw the line. You got it here, 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 and then you have here. All right. At this point, this is a higher low. This right here, the higher low. Okay.
Okay.
That is where you want to trade. The first higher low after the change in trend. Because you can see that it was in a downtrend here. You see it went into a downtrend,
Mm-hmm.
right?
Mm-hmm.
So when it,
Okay.
that is where you want to trade. Here, 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 and then you have here. All right. At this point, this is a higher low. This right here, the higher low. Okay.
Okay.
That is where you want to trade. The first higher low after the change in trend. Because you can see that it was in a downtrend here. You see it went into a downtrend,
Mm-hmm.
right?
Mm-hmm.
So when it goes into I'm messing up here. Hold on here. There we go. Arrow. So we got a downtrend here. And then you have it reversing and going back into an uptrend because this is a low, this is a higher low, this then becomes a higher high, and this is the first higher low in a downtrend. I mean, first higher low, excuse me, in an uptrend. So this is a higher low. So that's one reason to take a trade is a higher low, the first higher low in an uptrend. Okay, and that's one. And then let's look for the same thing in a downtrend, and oh, that's good. That's good. So we now have an uptrend. Excuse me while I get all this out of the way. We now have this uptrend. Right? And now it's trying to go into a downtrend. And and then as it's trying to go into a downtrend, you can see the uptrend here. And then I'm going to go back to my lines and I'm going to draw this so you can see how chaotic it is. So you got here, here, here. So it's really not it's not in any kind of trend, right? It's just It's just moving sideways. But then she goes into a downtrend by making a lower low here. So now she's going into a downtrend. Now this is your first lower high in a downtrend. So this is where you want to take that trade going to the downside here. So that is it for today. Because I can go on and on and on. I told you 30 minutes has been about 40. So what I want you to do is look over that. I'll give you a quiz the next time we talk.
Okay. All right.
Okay. So did you understand that? That's the next question. Did you understand some of the stuff that I was going through? Did I go too fast, too slow? Give me your thoughts.
I understood I say like 50-50. And that's just only because my learning style, like I have to watch it several more times and really hone in, but that has nothing to do with you. That's just how I learn. I have to watch it over and over to pay attention to every little, thing. Yeah. But no, I'm definitely learning from there.
And that's why I recorded. So you're more than welcome to, get the recording and look at it over and over again. If you want. Matter of fact, what I'll do is I'll share the link with you from YouTube.
Okay, perfect. Yeah.
You can then take a look at it. But it's about, I'll cut it so it's not super long. But I just hope you got something out of that, because the next step, everything that I teach you is going to build on itself. This is the basic foundational thing right here.
Mm-hmm.
There are several kinds of charts, but I'll only show you two or three. We'll get into that next time. Because all I use candlestick chart, and that's what this is called. This is called a candlestick chart. Okay. All right. Well, ma'am, that is it. I appreciate you for showing up, and we will talk to you on the next lesson.
All right. Thank you so much, Rick.
All right. Cool. We'll talk later.
All right.
Worth his weight in gold.
What'd you say there, Quinn? Good morning again.
I said that was worth his weight in gold.
All right, appreciate it. Well, I think that this is good stuff, honestly.
Oh man, I wanted to interrupt you a couple times, but I forgot it was a recorder.
That's pretty good. Hey man, it sounds good too. So yeah, let's just queue up the next one, because we ain't gonna have nothing until that thing lines up over there.
Okay.
All right. And everyone, good morning again this morning. Can y'all hear me fine?
Good morning. Yes, sir.
All right,
Yes.
Cool. So we're going to go over what we're going to go over in part 2 today, but then we'll review part 1, and then we'll get into part 2. Part 2 is going to be 2. We're going to talk about the other 2 reasons to take a trade. It's flat. You see it. One right. Look, real flat. Yeah. 800, 8100 looks flat. Everything looks flat. Yeah. Also going to talk. So that's what we're going to go over in today's session. I don't know where that went, but I won't worry about it. So let's do it again. Part 2. Reasons. Take a trade. And if it doesn't break that low, that's it. If it breaks a low, it's over with. Talk about more than get review, right? In part 1, it was Carmen and I on live last time, but in part one, we discussed 7 things the market can do, which is a higher high, higher low, lower low, lower high, double bottom, double top, and reversal. In part one, we also talked about the types of reversals. There are 4 of them: the ABC, the 1, 2, 3, the 2B, and the 3-bar reversal. And in part one, we also went over 2 of the 4 reasons to take a trade, which was a higher low and a lower. Okay. Today's session, we're going to go over part 2. And those are going to be the other 2 reasons to take a trade, which was a higher low. And have another person to join. If he could go on mute for me, Genesis. Thank you. Then today's session, what I'll do is I'll go ahead and restart. I know Genesis just got on, but I'll restart and kind of go over Genesis. Last week we went over the review for part 1, which was the 7 things market can do. If you didn't if you didn't take if you didn't have a chance to look at that video, or if you did, this is a review for 7 things market can do, which is the higher high, higher low, lower low, lower high, double top, double bottom, and reversals. And we went over the 4 types of reversals, which were the ABC, the 1, 2, 3, the 2B, and the 3-bar. And then part 1, we also went over the 2 of the 4 reasons to take a trade. Which
bar lower than that previous bar.
I think it is.
you can put that in your notes. You can have that
Yeah, I think it is.
for later for review. And I can talk to you guys one-on-one offline after
Okay.
session
It's
today.
too tight anyway. It's too tight.
Today, we're going to go over
Things
I
going.
paused real quick because
I think that might be lower than that.
you guys on the other end. Do I need to?
Lower.
Okay. You know what? I didn't even realize my speaker was on. So I apologize. What'd you say now, Quentin?
That was it. Because
Okay.
it was
Because I think it's I turn my I'm gonna go on mute so we can listen to it. My apologies.
no problem.
All right.
the other 2 reasons to take a trade, which would be, write this down. I'm going to type it in the thing here. The other 2 reasons to take a trade one of them would be a divergent lower low, and then a divergent high high. Okay, I see it. Now this is interactive, so if you guys want to ask questions, feel free to, but just go on mute if you're not asking a question. So this is interactive.
Well, first of all, good morning, everybody, and I wanted to welcome our guests, our new team members, or the young ladies that I see, and say welcome to the team.
Thank you.
So, all right, thanks a lot, Quentin. So that we'll go over the divergent. This is the divergent lower low and the divergent high high, the other 2 reasons to take a trade, and the market structures. So I'm gonna put Keith on the spot for me. Keith, you should know this, I hope. Can you tell me the type of market structures? Because I'm going to type it here for everybody so that we can kind of get input from everybody besides, other people besides me. So can you tell them to me? Market structures, you got a higher high. So you got a higher.
Can you pause it for a second, Quentin? I want to say something real quick here.
Hold on a second. Let me type.
You want all the market structures, just the reason to take a trade?
No. The market structures, like that.
Yeah, market structure.
Quentin, can you pause it for a second?
Structure. All right, let me type it in because I can't type as fast as you can talk. For 1 second. So I got it.
Ladies and gentlemen, we are in a wait and see mode right now. I'll tell you what has happened this morning. first of all, it went down and it gave us a trade to the downside, but it was very shallow pullbacks and it was moving kind of ferociously to the downside. So I didn't call it because it was just moving too fast for me to call it for a group of people. And right now we got to wait before price has to get above 905 or below 865 before we entertain a trade, because until then it's in consolidation and it can go either way. So we just need to chill until that point happens. Essentially what's happening right now is the market's just digesting the move that it made. That's all it's doing, is just digesting the move that it made. All right, that being said, I'm gonna go on mute and let the class continue to play.
Market structure. High. Other. Market structure. Huh? What you missed, I'll tell you the inside. I know we don't talk about much about the inside structure. Tops. Structure. And then you got a market structure that's a inside bar. I said inside. Okay, so those are your market structures, and we're going to go over and talk about all of them today. So the two reasons to take a trade is divergent lower low and divergent high high. What we're going to do is we're going to go over how do you define divergence. So let's talk about that. Because if you don't know what divergence is, how are you going to know how to look for divergent high high or divergent lower low? A divergence is when price and the indicators are doing opposite things. Again, divergence is when price and the indicator are doing opposite things, i.e., for example, the indicator is making a lower low, but price is making a higher low, or price is making a lower low, and the indicator itself is making a higher low. And what I'm going to do is now I'm going to add into here that's not the one I want.
Can you pause it for a second?
That's the most important thing.
We have Can you hear me?
Yeah.
It's moving too fast. Man, this thing moving too fast. Jeez.
Yeah, the volume, volatility.
I mean, it's real today. It's real today. Let's let it go. Hopefully it goes up a little bit here, because yeah, that volatility is all over the place. So you can go ahead and play it again. I'm not gonna force it. Let's just go ahead and start playing it.
Ready?
All right.
So this over here, so I can see. Uh, we'll go for divergence first, right? So what I'm doing now is I'm looking for, and I'm going to get out of this area so that, does everybody have that written down? If you need more time to write this down, let me know. If not, if I don't hear anything, 3, 2, 1, I'm moving so we can look at price and look and find some divergences so you can see what I'm talking about. I see one here and it's clear as day. So now, this is an example, right? Price made a low here and it made a lower low here. So it went lower here, right? So price went down. However, if you look at those exact same 2 points, the indicator made a higher low there. So price made a lower low. Indicators made a higher low. So price made a lower low. Indicator made a higher low. Does that make sense? And if it doesn't, that's okay. I want you to ask questions because I want you to ask me questions so we can go through it kind of, I'm not going to say it at length, but so we can definitely make sure that you see that. Can you see where the indicator here made a higher low and price made a lower low? That is what you call it. That is a pictorial definition of divergence. Okay? That is a pictorial definition of divergence. Let's see if we can find one coming from the top, and that will be a divergent higher high. Let's see if we can find one. And I want it to be obvious too. And we will scroll until we find one. Yeah. That's one right there. I don't like it, but I'm gonna show it to you because I think that it does the purpose. This is here is an example of a divergent higher high. If you compare these 2 points, you compare these 2 peak points right here. They're going in opposite directions. So when that happens, you have a extremely high probability that price will then go in the opposite direction, meaning down in this case. If it's divergent high high, it's probably going to go down. If it's divergent low low, it's probably going to go up, right? So those are the 2 kinds of divergences, right? And those are reasons to take a trade. Those are the other 2 reasons to take a trade. When you have a divergent high high, or you have divergent lower low. So I gave you 2 examples. Does anybody need me to do any more examples or have any questions that they might have for me right now?
But just to clarify, when you do see that, like you just drew there, that if it's that way, if it's a divergent higher high, then there's a good probability it's going to go into a downtrend or down.
Oh, it's going to go down. Correct. That is absolutely right.
And vice versa, if it's like on the other example, if it's a lower low, then it's a good chance it's going to go
up. Correct. Like in this example here, you see the divergence.
And then it does it. You see it clearly go.
Right. Right. So that you have it's extremely high probability. And when you have confirmed, when you have divergence going from the top to the bottom or from the bottom to the top. So it's pretty high probability, right? The next thing we're going to do is go over market structures, okay? I am going to expand this chart out a lot, and we're going to talk about market structures. So when you talk about a market structure high, right? Or you're talking about market structures high, in this case, I'll use this example. You see this bar has a high, then this bar has a higher high. When price breaks the high of this bar, let me use my tools to get my arrow here. When price breaks the high of this bar right here, then you have what you call a market structure high, right? So, and I did it wrong. Let me move the drawing so you can see it. When price breaks the high, you have one high here, you have this high here. So when price breaks this high, now you have a market structure to go up. And here's a firm way to look at this. When market structure happens to go up, momentum is also considered to be up. Let me show you what a market structure now looks like. Market structure now, as far as the market structure low is concerned, it's the exact same thing. You have this low, and then you have this low. When price then, go back to my tools, breaks this low bar here, when it breaks that low bar there, then you have a market structure going to the downside. When it does that, you have a high probability of that momentum now being down and it continuing to go down to some degree. So that's the market structure high, and that's the market structures low going down, right? Now, let's talk about the inside bar, and I'm gonna find a bar that's inside bar, and I'm gonna highlight it here. The market structure that's the inside bar is here. This bar here, I'm highlighting it, and I'm trying to make it big so you can see it. This bar here is inside, and let me do it this way because you can't see it. So let me erase that and then put an arrow, right? But you see the bar that I'm talking about here, so let me erase that. And then let me give it an arrow here. That bar there, the bar right there, is inside the previous bar, meaning that it has a lower high than the previous bar and a higher low than the previous bar. That is an indecision bar. And essentially all that means is price is indecisive as to which direction it's going to go. But the probability is based on the color of that candlestick, right? Based on the color of this candlestick, and we'll get into that too. That's going to be a bonus that I'm telling you guys about later on. The candlestick here is red. So this inside bar turned red. So you have a high probability if it breaks the low of this inside bar, it's going to go down. And that's exactly what it did, right? We'll look and see if we can find an inside bar that's green. We'll look for one of those. Oh, this is a green inside bar. This is a green inside bar. Here, let me draw an arrow. Here we go. This bar here has a lower high and a higher low than this red bar, and it turned green. Now, this is how this worked, and I think this is very interesting to show. You see how then price made a lower low, lower high, and it turned red, but the next bar, it turned green and it took off. That's what you call a fake out. That's a little bonus information for you right there. That's literally called a fake out, because that inside bar, this bar here turned red, faked everybody out, got everybody scared, and then took right back off to the upside. And that happens often. And I want to look for another one where it actually does what it's supposed to do, because we want to look for a green inside bar that this here is a green inside bar. Doesn't look like it, but I think that it is. Nope, it's double bottom. Double bottom. So that's a double bottom. So hold on. Looking for a green inside bar. That's another green inside bar, and as you can see, it went up from there, because that green bar here, again, let me draw the arrow. So if you look and see here, see that? Then the inside bar, bars has a higher low than the previous bar and a lower high, and it turns green, and then it shoots, it goes up. This is a consolidation because it really doesn't move anywhere. It goes up, and it comes down, and it goes back up, and then it shoots down, and then it goes back up. So it really, that's kind of consolidation area. But those are your market structures. We also want to go over a double bottom and double top. Then I saw one, and then I scrolled past it. So let me see if I can find it again, because I want to go over again.
Can I ask a question?
Yes, sir.
On that inside bar that you show with the fake out,
Right.
is that considered an inside bar market structure?
Yes.
Even though it didn't. Okay. So inside bars, I thought they depended on the next bar. They had to break the high or the low, depending on which way you were going. So
No.
fake out. I didn't know. I was asking, would that be considered still considered a market structure? It was an inside bar, but the next bar went down. Unless it was both on the outside.
Right. So if it's an inside bar, it's considered a market structure, because if the next bar breaks up or down, it creates the market structure. Does that make sense what I'm saying?
I guess that's what I'm asking. Okay.
Yes. Yeah. So if it breaks,
Next bar has to, the next bar determines what type of market structure. Inside bar market structure.
it's an inside market structure, right?
Okay.
Got it. So let's look for a double top and a double bottom. I'm looking for, those are sometimes harder to find, but we will
Just past the green bars, just past one, the double bottom. Go back a little bit. Go right there.
Yeah, you're right. Look at you. Look at your keen eyes, keen eyes. So, ladies and gentlemen, this would be considered, right, the double bottom, right? This is what you call a market structure. And when you see a double bottom, it typically is a reversal pattern. That means price is going to then, from a double bottom standpoint, is then going to go up, right? So from a double bottom perspective, you then see price go in an upward direction. Okay, so you see that, and then let's look for the double top. If y'all see it, point it out. I'm looking forward to.
And you said on the double bottom there, that's an indication of which way the trend is going to go?
Well, price at that particular point. If you get a double bottom, price is typically going to go up if it breaks the high of the bar that caused the double bottom.
Okay, yeah.
So if it broke this high, it's typically going to go in this direction.
Okay.
All right. That's a good question, Point. I appreciate that. So that's good. I'm looking for a double top. If somebody sees one, let me know. Because for some reason, I don't think this is a double top.
No, it's not. So. Didn't you have a double top earlier when you was trying to find an inside bar market structure?
I had that double bottom.
The double bottom?
Yeah, I had the double bottom. And that's the one Quentin pointed out when we came through. Come on now.
No, right there maybe?
Right where?
Red and green bar?
Right here?
Further over.
Right here. You're talking about these two. That's close.
The next two.
Right, these two right here is red and green bar right here, right?
No, the next two red and green bar.
Oh, man, I must have the glasses on because I didn't see that. That's pretty good, Keith.
The better one might be the other one if that's one. I paused it for a second. Am I looking at this right? Volatility slowing down a little bit, and the trend, downtrend is shaping up in our favor.
Oh yeah. You looking at it right. I was going to wait a second to see how this thing. But you're right. It's all thing we're waiting for is market structure pullback on the 900 now.
Okay.
And then once what I did was I had to put the arrows back up there because I was going to tell you when to get in today, but I don't have to put them arrows back up there. That way I can just say, hey, if you get the arrow, you know what I mean?
Yeah.
It makes it easier because that volatility was no joke because I was gonna be like, hey man, we're gonna add here. And it's just no. that was quick. That was quick. So we're just waiting, ladies and gentlemen, we're literally just waiting on a market structure pullback on our 900 volume chart, which is the third chart from the right. I hope it gives it to us. Good night.
Yeah.
The first trade, we did have one trade today, just out of full disclosure, but we weren't quick enough on the trigger to get into the entry, which is why we didn't get an opportunity to take the trade. So now we're just waiting on the market structure here.
Let's do it.
All right, you can cue it back up, Q. I'll let you know when it.
Oh, okay. All right, I'm watching it too.
All right, cool. And if you see the market structure, because I'm looking at it, but I'm having to take my eyes up and down from your screen. I mean, from the big screen to my screen.
Yeah.
Yeah, it's about to fall.
It's supposed to go down. So if you look at
Yeah, and it did in this case because it didn't break the low, right?
so we keep going over 7 bars, 6 bars. Is that one? Yeah. To the right. Small stem on the red one. Well, I can't. That's what I'm debating.
Yeah, you can't see that one. So let's go to something that's a little bit better here. We went over that. Went over those. Went over those. Those. That is amazing.
Right there. No.
Yeah.
Right. Missed about 2.
But you do have a double top, though. It's a double top, but it's let's see what it does. Is it gonna go down? It's a red bar right here. Inside bar, then a double top. You see that? Right there. Right here. Right here. It is a double top right there. This bar and this bar. I was trying to find tweezer tops. Tweezer tops are nothing more than the bars that are right next to each other.
So they don't have, I was going to say they didn't have to be next to each other.
They don't have to be next to each other, but for teaching purposes, it's easier for people to see.
Yeah.
There it is.
Right there.
That's the double top, right? That's the one. And ladies and gentlemen, this one here, in my opinion, is that's like you salivated something like that, right? Because when you get this market structure up, because you have an inside bar and it broke to the upside, it then gives you a double top. And if it breaks this low, it has a gargantuan opportunity to go to the downside. I mean, that's almost a no-brainer trade.
What else is there if you want to fuck with it? There you go, Pete.
So no, we just want to stick to the double top. I mean, because we're just sticking to the market structures there.
There's an ABC pattern. You talked about that. Right?
Yeah. So yeah, we not getting nobody no quiz today because they'll be like, look here, man, we didn't come here prepared for that. So yeah, but those are your market structures, and those are your other two reasons to take a trade. So let's now go back and review what we talked about today. Right? Let's go back and review what we talked about today.
If I can already see what kind of teacher you are. Right? I just think you would. Yeah, you feel like,
So here we go. Right? Part two, we went over, hold on a second, because I think I did that. Let me go back and rescale my reset. I don't like that at all. All right, so here we go. Today, we went over the market structure high, the market structure lows, right? We went over the double tops and double bottoms, and we went over the inside bar. We also went over the lower lows, the version lower low, and the version high highs, right? As a review, and continue, to go over that review again. In part one, we went over quite a bit, which was the 7 things the market can do, which is there. The reversals, which are there. And then the two of the 4 reasons to take a trade, which is the simpler reason to take a trade. So we've gone over all those things. The next class we have, we're going to be putting this all together, and we're going to talk about multiple time frames and how you put that all together for a trading plan and to put the probabilities in your favor, right? That's what we're going to do next. As a matter of fact, let me go ahead and show you this. I talk about the candlestick bars, but these are what you call candlesticks. But in trading, right, this is bonus material, not anything extravagant, but something for you to kind of sink your teeth into. You have candlestick bars, but you also have, I like to mess with people with this one. You ready? Watch this. You have some people who trade on mountain charts. That's what you see on CNBC and all that kind of stuff. You see, you see the mountain charts. You also have those are hollow and closed bars. Those are called hollow and closed bars. You also have, these are just the popular ones, right? That's something that people use. You also have point and figure. Point and figure looks like such. Oh my goodness. They disappeared. Hold on. Those are wrinkle bars. Wrinkle bars are nothing more than candlesticks without the groove structure for the most part, right? And then that's it. That's it. So those are your 4 main types of charts: your bar charts, candlestick charts, mountain charts, and also your wrinkle charts. So with that being said, that is class for today. And that, which is a,
You record the session?
I did. It's on YouTube.
Oh,
Yeah.
Okay.
Yeah. So it's live on YouTube. So so it is that, and please tell me, are there any questions and or comments for me right now? If there's not, I'm not gonna hold you ladies and gentlemen any longer. Just let me know. I'll give you a couple of minutes just to make sure.
Nah, that was pretty good. I don't have any questions at the moment.
All right, cool, cool. So, well, if that's it, Genesis, you got any questions? Carmen, you got any questions?
I don't have any questions. Thank you.
Oh, absolutely, Genesis. It was good talking to you. Good seeing you come in today.
Of course. I didn't have no plans this morning.
All right, cool, cool. All right. Well, we'll talk to you next time, okay?
Okay.
All right, bye-bye.
Bye.
Carmen, you got anything?
Not at the moment. I mean, I'm gonna go and rewatch it again and take some more detailed notes, but I don't think I have any questions currently for you.
Okay, all right, cool. I just want to make sure because I was trying to hit the button, but I didn't get on there. Okay, cool. So, all right, if that's the case, everybody, we're gonna go ahead and call this today, and you guys have a very, very happy New Year, and I will see you.
But don't forget
I'll
to,
talk to everybody later on today anyway, so I'll just see you guys a little bit later on.
don't forget to subscribe to the channel. And you can also ask questions at support@theprofitstopper.com. Hello again, Carmen.
Hi, how you doing, Quentin?
I'm just right. Just like I want to be.
Right.
All right, everyone, we're going to be getting started with part 3 of our how to read the markets. All right, so we'll get started here in just a second. Give me a slight moment to go ahead and get everything loaded up, and I'll be with you in 1 second.
All right.
I do see the market structure forming here on the 900.
All right, ladies and gentlemen, part 3 of this
But everything's not
section
lined
of
up.
how to read the markets is about putting it all.
But it's not lined. Everything's not lined up though. So for the short, that is.
So I don't see the market structure on the 900. I see that it happened from earlier here.
Yeah, that's what I'm talking about there because I didn't see if it was already to the end.
So which one are you? At what time are you talking about?
Right in there. But I'm mistaken because everything wasn't lined up.
Okay, all right, cool.
11:15, something like that, but everything wasn't lined up. It didn't even go in our favor. Everything just completely changed. If you're looking at the longer time frames.
Right, it did. It started to change then. Okay, all right, cool. We're waiting on it.
All right, I'll start it back up.
All right.
Together. In the previous sections, previous parts, we've talked about the 4 things the market can do, the 7 things the market can do, which is a higher high, higher low, lower low, lower high, double bottom, double top, and reverse. The 4 reasons to take a trade, which is a lower high, a higher low, divergent higher high,
and divergent lower low. And I apologize, you can't see my face, but now you will. All right, so here we are. So, and we also talked about the market structures, the inside bar market structure, the higher high market structure, the lower low market structure, the higher low market structure, and the lower high market structure. We also talked about the divergent trades and how to see those divergent trades. So today we're going to go over how we put it all together so that we have an identification on how exactly to read the markets. And it literally is like reading a newspaper, like reading books. You just have to read it from left to right. And when everything lines up, then you know you have an opportunity that has a higher probability of winning. And in addition, you have an opportunity to win big. So here we go. We're going to go over everything, and then I'm going to go over everything as a whole, and then we're going to segment each chart out so you can see what I'm saying. All right.
All right.
So example one is right here. I'm going to use my pointer most of the time. Okay. Example one is right here where you see the market is moving down. Everybody can see the market is moving down, and everything's red and red. So because the market's moving down and everything is red and red, now we know we need to be looking for a short. All right. And everything is now moving down red and red on my new chart to the left, to the right of that, which is the 2700. The largest time frame is the 8100. So you have the 8100, 2700, 900, and 300. So on the 2700 chart, now that we see everything is going down red and red on our 8100, now we look into our 2700 for a pause in the market. Where you see that little green bar right there, that's an identification for a pause, right? That's an identification for a pause. And then if you come over here to then the 900, you can see very clearly why I talk about the market structures. This is a market structure lower high. It made a higher high, and a higher low here, and then it broke that high. So this is a market structure here, and it's a lower high. And then the only thing we do then at that point is we look over here and we see where we have the ABC pattern. And then when price closes below that ABC pattern, we enter into our trade. It's simple as that. That's all we do for all of our trades. Now, let me show you, I'm give you a few examples of this because I think it was 4 of them yesterday. It does this repetitively all the time. And once you understand how to read that, then and only then will you be able to consistently be able to make money in the markets on a consistent basis and not have any worry, because you'll know exactly what you're doing, right? So let's go to the second one, which is the same thing. Market's moving down as we see on the 8100, correct?
Mm-hmm.
You see the pause in the market that happened, right? And then you see where the market gave you, the market structure gave you a high, low. It broke the high of that bar, right? On the 900. And then on the 300, where you see that green box, price closes below the ABC pattern, and then she goes down. So that's trade 2. There were 4 trades yesterday, all of them won, and I'll show them to you. So let's keep going. Now we entering that on the 300, right? Yes. Okay. So same thing here. We have another lower high. Market's going down. Then once the market starts going down, let me make sure I got the, sorry. And then you see here where it gives you the pause in the market. You see that green bar at the pause, right? Right there. And then you see the market structure here, the lower high. I'll scroll over a little bit so you can see that it's a lower high than all the previous bars. And then here, you see where you have the ABC pattern. It's slight, but it's an ABC pattern here.
And that's that 4 reversals. And I apologize because I didn't mention that before. The 4 kinds of reversals. You got the 2B, 3B, 1, 2, 3, and the ABC.
How many bars form a market structure?
We would have to go back to the second part of the class, but you can have many kinds of market structures. You have 3 bars, you can have 4 bars, but you have to have at least 3 bars to form market structure.
Thank you.
All right, all right. And here you see the ABC pattern,
Mm-hmm.
and you see it close below. You get into the trade, and as you can see, it just cascaded down
Mm.
to the downside. So you know that you were right on taking the short. And here's the last trade of the day. Same thing. You see price making a lower high. It's cascading down.
Mm-hmm.
It gives you that pause bar right there. You end up getting a very slight market structure, even though it's slight, it's still a market structure nonetheless. And then you end up getting that trade here on this ABC, double bottom ABC pattern. And then when price closes below, you enter the trade. And as you can see, that trade went literally.
Can you point out the ABC pattern again for me? Now you label it.
So here's your ABC pattern. Let me look here. That's not what I need to do. Hold on. Let me go to tools, type text, type text. You got A. You have B. And you have C. So that's your ABC pattern. And then it completely, once you get into the trade, it goes in your favor a little bit, then it meanders, and then it just falls apart. And then now what we're going to do is we're going to segment each chart so you can see exactly how this goes. The reason to take a trade is always on what I call that fourth of granddaddy of them all charts, right? You want to take a trade based on either it's a lower high, higher low, divergent higher high, or divergent lower low. I haven't put divergences up here for the simple reason we don't trade divergences in our actual room for the most part. We don't trade divergences for the most part. But if you can look at here, you have a lower high. This is an overall swing, lower high. Remember when I talk about swing lows and swing highs? And when you talk about swing lows or swing highs, this is a swing high right here, but it's a lower swing high. So you have a lower high right here. And that way you can take the trade. You have another lower high right here. And then when she gets going, you can take the trade. Then you have another lower high right here. When she gets going, you can take the trade. And then you have another lower high right here. When she gets going, you can take the trade. It is really that simple. But the hard thing about it for a lot of people is being able to wait on the exact setup. So now that you have that in place, now let's look at the momentum piece, because now we're going to get into the momentum, trend, and timing piece of why you do what you do. Okay. Let's go again here. Momentum is down. You can see that because we have a market structure down and it's not going up. It's actually going down. It gives you a little pause bar right there. So momentum is definitely down right here.
Mm-hmm.
So that's momentum on that chart. Then you have momentum down here with another little pause bar. So you have momentum here. And then same thing here. You have momentum going down, not trying to push up. Momentum is pushing down. So now your trend and your momentum is both down on your larger time frames. And then guess what? We're going to have a situation where on your trend chart, guess what? Now that trend is down. You see that trend is down here? That trend is down right here. And earlier in the day, when we had those other two trades, you will see too that I'm trying to get there. Give me a minute. Let me pull it down.
Day trading. Well, I haven't taken any of my.
So this is the second trade of the day. You can see the trend is definitely down here, right? You got a lower low, lower high, another lower low, another lower high. So now your trend is definitely down there. And in addition to such, you have, I thought it was one more. Could be wrong. Maybe that was the first. Oh, I didn't have it highlighted. It was here.
I'm trading.
It was right here.
I'm also looking for black.
All right, the trend went down, right? Pull my tools up and pull that right there. Trend went down right here. So I remember the trade being at 939. So now your trend is down. So now we've talked about it, right? The reason to take a trade on the 8100, lower high, higher low. Is it a divergent higher high, divergent lower low, right? Then you start to go here and you start to look to your next time frame and you say, okay, cool. Is my momentum now in the favor of the direction I'm trying to take the trade? Answer to this question is yes. Then now we go to the next. If the reason to take a trade is there, yes. And then if momentum is down, answer is yes. Then the next thing we do is go to the trend chart and say, hey, is the trend down? Yes. If you answer yes to all those questions, the last thing to do is to then answer your timing piece. You're going to get in on one of the four reversals. My favorite reversal to get in on is the ABC reversal. So we're going to scan these charts, these charts here. I'm going to show you. I'm trying to get to that time frame, ladies and gentlemen. Give me 1 second.
You know, it's more of the same, but I just use it, you know, for now. I don't.
That's going to take a while.
Get off focus.
So let's do it this way. And then do it this way. We're going to start at the beginning and then we'll take it to the end. This session will end at about 30 minutes. So we have about 12 minutes left. About 12 minutes left. So just give me a second as I take the charts where they need to be so that you can see the timing mechanism. That's the second trade of the day. Let's get to the first trade of the day. To the 940, 939 area. Should be coming up fairly soon. There it is.
What happens is a child is doing well.
Okay. So now I'm going to zoom in and show you the ABC pattern here.
Exactly. So that's what I'm not.
And as you can see here, I'll draw it so you can see it. You can see the ABC pattern in each of these trades. Now, that's my favorite one to enter on. There are three other reasons you can take the trade. You can take the trade off the 3-bar reversal. You can take the trade off the 2B reversal, which we use the 2B to confirm the ABC pattern. And there's also the 1, 2, 3, which is my least favorite to enter on. But these kinds of trades, if you take them off the ABC pattern, they just work well, right? They work well. They work well. They work well. They work well. So That's trade one, right? Trade two, same thing, and that's your timing piece. Trade two is going to be essentially the same thing. We'll be able to get to it here. That's it there. Same thing. We got the A, inside bar there, B, C. That happened there. Grade then close below. Guess what? Grade works. Right? And then it gave you another ABC pattern there. So that's that. And then you had the other two trades. Let's get to them.
That's what I do. Oh, yeah. It's just, if I start going on, when I start.
And then that's taking a while, huh? So as I'm scrolling through here,
Listening, thinking through what I'm saying. Just, here's my thing, real quick. Nope.
did I pass it?
And that's a constant thing. So
I don't think I
for
passed
me
it.
to keep peace, unless it's something that's life or death. Literally.
No,
I just
there it is. There's the third one. ABC pattern. A,
Okay, Lord, here we go.
B, C. Same thing. You enter, this is your timing mechanism, and that's how you enter the trade to the downside.
Third part.
So that's the third trade of the day. And the last trade of the day happened right around here. This was the A, B, C pattern. So now, when you're trading, the most important thing that you want to know, the most important thing that you want to be able to see is you want to have your reason to take a trade. You want to see momentum, trend, and then time. That's it. That's putting it all together for you, ladies and gentlemen. Now I'm going to open it up for questions to see if there are any questions for me that other people may have questions about that are not actually on the go.
I mean by that, I'm not talking about.
As one of my good friends say, don't everybody speak at once.
Okay, I do have a question. So what I'm looking at here, is essentially the same line of candlesticks divided up into time frames based on the numbering of these charts.
That's correct. So I'll give you this. This is a bonus because you asked me a bonus question, so I'm giving you a bonus answer. So we derive all of the charts that we use are volume charts. Everybody in the world uses time charts, right? As a former professional trader, I know for a fact that price and volume rules in the market. The only thing I really want to see is price and volume. Price does not trade in time, it trades in volume. Price, again, I'll say this again, price does not trade in time, it trades in volume. So price and volume are the two most important things that you can look at on any trading chart, because it'll tell you everything you want to know. All right. So the way I derive my time and my volume charts, or the way I derive my volume charts, is I take the average volume over a 30-day period of time, and I divide that volume by the number of days in that trading month. And then I take that by my time frame differential that I'm using, which in this case is 3. And I divide it by 3 until I get to a sequential amount that is equivalent to the average volume for the previous month. I'll say that again. What I do is I take the volume over the last month, how many trading days it was for that month, and then I divide that volume by whatever my time frame differential I want to use, which in this case is 3, until I get down to a tradable amount of volume that allows me to be sequential with that volume based on the previous one. That's all I'm doing. So that's how I came to a 300, 900, and 2700 and 8100 volume chart. Did I answer your question?
Mm-hmm.
Are there any other questions for me? No more questions?
And you, I came in on a little bit after. So I was listening to you, kind of go from the, the 8100 to the 2700 on down.
Okay.
So you were looking at, I guess the first thing you were looking at on the 8100 was what, I guess just the fact that it was going down. Because I know you said when you got to the 2700, you were looking for the pause in the market.
Okay, so I'll give it to you so you know. The 4 reasons to take a trade, which are lower high, higher low, divergent higher high, divergent lower low. That's the only thing I'm looking for on the 8100. Right?
Okay.
Then I move over to my 2700 to ensure that my momentum is then going to the downside.
Yeah.
Okay. And then also what I do is I wait for opportunity. Hold on for me 1 second, ladies and gentlemen, please. Give me 1 second. So what I do is I then go to my 2700 to see where my momentum is. Okay. And then I line that up with my 900, which tells me where my trend is.
Yeah.
All right. And then I go to my 300, which is my timing mechanism. Okay. I do that in sequential order so that I can ensure that I'm trading with the trend and momentum of my largest time frame. Because if you notice, I really want my trend of my 900 and my 8100 to be doing the exact same thing. That's why we call it a trend within a trend.
Okay.
And that's what
Okay, and you said you're on your large chart, you only looking for one of the 4 reasons to take a trade.
Right, I'm looking for only 4 reasons to take a trade, but I'm also looking to see if that is in trend as well, right? Because you can take a trend within a counter trend trade. We just don't want people in the beginning taking trend within counter trend trades until they get familiar and proficient at taking the trend within the trend trades first. Does that make sense?
Yeah.
Because the trend within the trend trade is the safest trade you can take. And it also is the most profitable trade you can take. But here's the caveat. It is also the trade that you have to wait for the longest to get a trade.
Yeah.
Did that answer your question?
Yeah.
All right, cool. I just want to make sure. Any other questions we got?
And then at the end of that, we are looking for one of the reversals on the 300 chart or the lowest time frame chart in order which to get our entry point.
That is correct. That is absolutely. Say it again, Quentin.
I said, based on what I've learned, we are looking down the 300 chart after we've done our looking for the reasons to take a trade on the 8100, making sure the momentum match on the 2700, make sure the trend follows the 2700, And now we're on our timing, so we look for one of the reversals to happen on the 300 chart, for example, like he's shown on the ABC pattern.
Correct. Correct. That is correct. Ronald, did you have something?
Yeah, no. I'm listening to the question. That was perfect.
All right, cool. Well, I'm gonna ask again. Are there any other questions?
Just to be clear, you take the trade at the 300 chart, you said, correct?
That is correct. That is correct. All right. Any more questions? Going once. Going twice. Going three times. So,
I think for doing this and putting this together like this training class, I think this is going to help us continue to be even more profitable. Going back looking at parts 1 and 2, and then summing everything up with part 3. So thank you very much.
oh, absolutely. And ladies and gentlemen, I didn't tell you this, but we're going to be training. There are 52 weeks. I got 52 trainings set up for you. We got another training that talked about scaling on next week. So we're going to get into, well, now we've learned how to read the markets. Now I'm going to teach you how to capitalize on the markets. And to capitalize big, like a professional trader. So that's the next step in the process. We have 52 weeks of training set up. So please join, subscribe, like, share if this is an interest to you. So if we don't have any more questions, ladies and gentlemen, I'll go ahead and end this session. This is part 3, the last part of the first part of the series called How to Read the Markets.
This is a rental that. Hold on 1 second. All right, the playlist has completed on those 3 trainings. I see the market is completely went in the direction opposite from what we were looking at. Do you have a different playlist, or you want to have a discussion of what the market is doing right now? Because it's taking off.
Well, no, man, I just need to sit up here and focus right now on the market. So you can go ahead and watch this. You can play that. You can start back with the playlist. Matter of fact, no, go back to the signs of getting rich.
Okay.
If you want to cue that up.
Yeah, give me about 5 minutes because I am on a call.
Okay, that's fine. That's fine. Go ahead. Do your thing.
All right.
All right.
All right, gents, I will start the book. Ladies and gentlemen, I will start the book up. How to Turn 5,000 into $1 million here. We can,
Okay, cool.
and let's see. Actually, yesterday we left off on chapter 15, and there are approximately 23 chapters. Do you want to start where we left off or start over?
Let's start over. Let's start over.
All right, here you go. Starting over. Guess I better take my earbuds out, huh? Because I can hear it, but y'all can't. All right, ladies and gentlemen, here we go.
As a speculator, you should try to be honest, at least to yourself. If I report some success here, it does not mean that I should not admit my mistakes as well. I have been wrong more often than I have been right. For example, I mentioned that I tried to short the DAX and Dow Jones several times between 2010 and 2012, even though we were clearly in a bull market. Actually, I knew it too well. Looking at the long-term chart, it showed me that the long sideways phase of the years 2000 through 2009 in the Dow Jones was over. And I had a good argument too. If the Fed lowers interest rates to zero, you can barely make any money with bonds. What does a manager of a large fund do in this case? Exactly. He increases his equity quota, because in equities, he can at least earn a return on the dividends. I knew it, and I even publicly proclaimed it at a podium discussion for investors in Brussels. Each speaker was asked to make a forecast for a market. I showed the audience a long-term chart of the Dow Jones on a big screen, and I showed them an upward price projection. Based on my analysis at this conference in 2010, I prophesied a Dow Jones of 20,000 points. The Dow Jones stood at about 10,000 points in 2010. One half of the audience looked at me skeptically. The other half just laughed. I saw my colleagues at the table on the podium shake their heads. The point was, I did not say this in the US, but in Europe. In the US, traders had already been back on the bull train for a while the Europeans were in the midst of the so-called Euro crisis. The media in Europe was full of negative news, and you could feel it in the general mood in the audience at that conference. People were so paralyzed by the negativity that they could not see the obvious opportunities in the US. I was laughed at, and nobody wanted to talk to me after the panel discussion. Who wastes time on a charlatan? And if Chapter 1. Can you become a millionaire on the stock market? Without a doubt, every trader is interested in the question of how to trade a small account up. How do you manage to increase this, usually small, seed capital? Or better still, how do you manage to make a small fortune out of this small sum? Preferably, as fast as possible. As soon as the money is in the brokerage account, most traders usually start looking for some kind of holy grail method, which sometimes takes years, as long as there is still money left. I would like to point out my views of things in this book. It will probably surprise some, and will certainly upset others, because what I have to say on the subject may not suit everyone. Those who have read my other books know that I am critical of the idea of making a fortune out of a small capital investment. Yes, there are traders who succeeded in doing this, but they are few and far between. And above all, there are very few who have done so with the traditional short-term methods. The goal of USD 1 million is a very high goal for most traders. In fact, some would say that 1 million is the sum you should bring with you when you go to the stock market. As the reader, you possibly know that this kind of money is no guarantee that you will be successful. Most traders do not have so much capital when they start anyway. So the question is quite legitimate. Once you have made the decision that the stock market is the best way, I know someone who made his first million selling ice cream. What do you need to do if you want to earn $1 million? Big goals need big perspectives. If you plan to earn USD 500 with trading, then you need a different perspective than if your goal is USD 1 million. This book is about how to adopt such a perspective. Unfortunately, many traders try to reach this goal by sticking to the USD 500 perspective. I just need to reach this modest goal for enough days in a row.
This down here, that's the long-term momentum on the 24,300.
Sooner.
No,
Or what chart you say this the long term for?
that's the long term for just more. So I want you to think, right? And when I say this, I'm not being funny. I'm saying everything I do is sequential.
Mhm,
So that's a 63, 27, 27, right?
mhm.
You go up to the other one, the other one is a 21.99. So if it's one's a 63, 27, 27, the other one is a 21.99, what time frame is that the 21.99 on? Because all you gotta do is divide by 3.
Um, hold on, 20. Which one? Which one's the 21.99?
This one. And this one right here. See, you can see the parameters, right?
Yeah.
So that's 63. That's a very long term. So this time frame here, gotta wait from I'm tripping. You're on a 900.
Mhm.
This is a 21.99. So if you multiply the 21.99 times 3, you'll get the 63, 27, 27 on the 900.
Okay.
You see this right here is that ain't supposed to be that right. You see how it's green? That long term on the 2700 is green?
Yeah. Oh, that's the 20. So this is the 27.
100.
Okay.
That's all right. That's all right. Every day in every way, I'm getting better and better.
All right, I'll start the book back.
Oh, my bad, man. You know what? I be tripping over here, man. My apologies.
No, that was good. That was good dialogue.
All right, cool. You go ahead and start it back up.
To reach their goal. And I firmly believe that the reason for this failure lies in their incorrect perspective. It is like looking for 5 cent pieces on the street. No doubt, you could become a millionaire by collecting 5-cent pieces. But in my opinion, that would take much too long. Incidentally, I only came to understand this simple truth gradually. I was one of those traders who looked for 5 cents every day. The tragedy of this approach is that every now and then, you actually will find a few 5-cent pieces. That little surge of happiness that one feels makes one think one is on the right track. No doubt, the person who collects 5-cent pieces will reach his million one day. For example, if he finds one of those coins every day, he simply needs to repeat the success for the next 20 million days. I think the reader will see the absurdity of this idea. So, if you set yourself a high goal, you should look for ideas that will get you to your destination a little faster than our brave collector of 5-cent pieces. In this book, we will look at how one can find such opportunities and what perspective we need to adopt, rather than walking around with our eyes glued to the sidewalk. I would like to present the reader with a strategy that, in my opinion, makes it possible to make a fortune on the stock market. I am not saying that this is the only way, because there are thousands of ways to make money on the stock market. But it is a radical method, because it assumes that, under normal circumstances, the trader with a small starting capital will not be able to achieve this. Nevertheless, the possibility exists to make a fortune on the stock market with just a small investment, by procuring the missing capital from another source, outside of yourself. The strategy that I present here starts with the assumption that the trader cannot achieve this with his money, but only with the market's money. He will have to learn to get the money from where it is, and he'll have to do it with chutzpah. In other words, he will have to take some serious risks. I think that speaks for itself. To say anything else would be a lie. Just as it is possible to build a real estate empire without a dollar of equity, so it is possible to build a large trading account within a relatively short time with a small starting capital, USD 5,000, or even less. I am contradicting myself here because I have already said in previous books that this is not possible. What I meant was that it is not possible to do so with conventional trading methods. In other words, you will have to go to very unconventional ways if you want to achieve that goal. Chapter 2. Trade with the market's money, not with your own. My best year of trading was 2008, but most of the money I got did not come from my day trading or scalping. Although those methods also worked well that year, most of my profits came from a single trade. A single. I earned more with that trade than I had in the previous 3 years. This experience was a kind of breakthrough for me. These are the kinds of moments when you discover completely new possibilities. That was the case with the one trade with which I made a 6-figure sum. It was the time of the financial crisis. Lehman Brothers was broke. The stock markets had plummeted. Almost everyone was sitting on big losses, while I was able to reap the biggest profit of my trader career because I was standing on the other side. No, I was not short in stocks, even though that would have been an excellent idea. I was long in silver. That was my only position at that exciting time. Long silver. I was convinced that in a crisis of confidence of this magnitude, subprime crisis, it would be a good idea to buy so-called crisis currency. Investors like to park their money in markets that are considered safe havens in times of turmoil. Traditionally, these are the precious metals, especially gold and silver, of course, but also currencies of certain countries, such as the Swiss franc or the Norwegian krone. At the time, I did not understand that this also included the US dollar. Escaping the risk usually helps the markets that are considered relatively stable or low risk. I chose silver because I assumed silver would outperform gold in this crisis. This assumption turned out to be correct, but unfortunately, it did not really materialize until 3 years later, when silver climbed to stratospheric heights in the wake of the euro crisis. Still, my silver trade of 2008 was a success, though the movement on silver in early 2008 was modest compared to what had happened in 2010, 2011. I started building smaller positions in the range of around USD 13 or USD 14. During the subprime crisis in late 2017, these first positions turned to profits quickly and easily. After a few days, I already had a book profit of over USD 1,000. Not bad, you might think. And under normal circumstances, I would have been happy with that gain, and I would have sold the position. Incidentally, I did not intend to keep that trade going for long. I gladly admit that the trade was intended as a day trade. Once the position had gained nicely, I thought, why not keep it going a little longer and try to get more out of the trade? And indeed, silver rose the next day, and I had the courage to buy another contract. But you have to be aware of the hysteria of those days. The media was full of bad news, not to say catastrophic news. The stock markets plummeted worldwide. And when the news of the Lehman Brothers bankruptcy on the ticker came on September 15th, the dam broke. The crisis was complete. My silver trade, on the other hand, did very well. The more the silver price rose, the more contracts I bought. A few days later, I already had 5-digit profits. But if you are now thinking that such a profit would lift you to a permanent state of elation, you are mistaken. Prices do not go straight up. I wish they would. Not at all. When markets go wild and volatility picks up, prices fluctuate so much that they can go just as widely the other direction. I remember that my silver position was USD 17,000 in profits one morning, and only USD 12,000 in the afternoon, due to a correction. A book loss of USD 5,000 in just a couple of hours. That was much more than I would allow myself under normal conditions. But you have to be able to live with that if you want to increase your positions systematically. Let me point out that I did not have a smartphone at the time. I'm a bit old-fashioned. Having a number of contracts in a trade market is a disconcerting thing. Actually, great success is also somewhat disconcerting, which is why most people prefer to live without it. So, I had to open my laptop every time to see what was happening to my silver position. At the beginning of January 2008, silver struck a resistance of about USD 15. This resistance had lasted for 2 years. I had placed several stop-buy orders above this level, all of which were executed when the outbreak came. Soon, I had doubled my position again. Now it became really exciting. The fluctuations in my account were now quite wild. Within a minute, I was several $100s richer or poorer, and soon it was to be thousands of dollars. See image 1, silver monthly chart, 2006 through 2019. I remember well that I felt I was on the safe side with this position. I knew that I had a winner, and that all I had to do was rigorously trade the upward movement in silver. This was an extraordinary situation, because I had only a few thousand euros in my brokerage account. I used it to experiment and perform occasional swing trades if I saw an opportunity. If I remember correctly, I had about 2,700 euros in that account. Not much, considering that thanks to this one silver trade, I eventually had a book profit of more than 40,000 euros. So within a few weeks, I had made more than 1,000% profit, thanks to the leverage I used and the fact that I traded with the money that was on the market. That was the whole secret of this trade. I did not trade with my own money. I traded with the market's money. I suggest that we take a closer look at this, because some readers might not understand what I'm saying. If you buy a property and finance 70% of it, you are basically not buying this object with your money, but with the bank's money. The bank pays for the major part of this property because it considers the property as collateral, and the house remains the property of the bank until the last installment has been paid. Something similar happens in the stock market. Once you have book profits, as long as you do not realize these book profits, you do not sell your position. That money does not belong to you, but to the broker. However, this book profit allows you to buy additional contracts because they will be credited to you through the daily settlement. So, this book profit allows you to buy a larger position than you would have normally been able to buy with your small capital. This is a comparable leverage, as if you were buying a property with a loan from the bank. And of course, you cannot call your accumulated book profit your own until you sell your position and earn the profit. But as long as you do not sell, you can continue to buy provided you are still right in terms of the market direction, and the trend continues to grow in your favor. This approach is very different from closing your position every day and reopening it the next morning, which is what a day trader does, for example. At first, day trading seems less risky, but it is easy to forget that every day, the trader carries the whole of the risk. He risks his money every day. His own capital is fully at risk. However, if you do as I did on the silver market in 2008, at some point, you will no longer be risking your own money. You will begin to speculate with the market's money, thanks to your book profits. Technically, you may not see the difference, but in terms of risk management, the difference is huge. As soon as your first purchased contracts run into profit and your book profit increases, you have a free trade, so to speak. From that moment on, you can use your book profits to expand your position. So you do not buy with your own money, but the market's money, or with the bank's money, if you will. Moreover, I think that you should not keep the leverage on your position too small when you find yourself in this comfortable situation. Quite the contrary. From now on, you should really grab the ball and expand your position seriously, because that is the only way you can make real financial progress. The same is true for the clever real estate investor. He does not buy his properties with his own money. He buys them with the bank's money. And the more properties he owns, the more he buys. It is a proven concept. If you research a little, you'll find that apart from those who have built a successful business, most rich people have become wealthy with real estate. Over the course of January and February of that year, silver rose to over USD 20. While it was on its way to the top, I bought more contracts. In the end, not as aggressively as in the beginning, because after studying the chart, I had the feeling that at some point, silver was going to reach a peak, and then the inevitable correction would occur. This feeling was soon to come true. In March, silver reached its high. The volatility was almost insane. I started selling my contracts and locking in on my profits. In hindsight, I sold a bit too late and lost out on some of the profit I could have made. But in hindsight, you are always smarter. The trade was a big success, and I was able to live on that kind of money for a long time. After I had closed the position completely, I did not do anything for months. It took time for me to recover from my own success. Anyone who believes that success is something great and simple is wrong. It is really scary because you are confronted with something that is unknown in you, something that is much bigger and more powerful than you. Chapter 3: Learning from the Grand Master of Speculators. In stumbling into this trade by chance, I unconsciously did something that would only become a real method in years to come. Of course, I knew what I was doing. I had heard of other traders who had completed these types of trades successfully. And of course, there are examples of traders in trading literature who have become wealthy in this way. But let's be honest, you can only really understand a method if you apply it yourself. Theoretical knowledge does not help you at all. Since I did not intend to do such a trade, I was not prepared for the potential risks of this method. Neither did I know what I would go through emotionally during the time I was holding that position. In retrospect, I took time to study the traders who had used this strategy successfully, and above all, of course, the American trader and speculator Jesse Livermore. He is probably the most prominent example of a trader who went the whole hog. You can read about Jesse Livermore on the internet. And of course, I also recommend the book by Edwin Lefebvre, Reminiscences of a Stock Operator. It describes the method we are talking about here in an entertaining way. Of course, Livermore did not master his method from the beginning. He started off playing the market in the short term, like most of us. Times do not change. At some point, he realized that the big money could only be earned with the big market movements. Of course, for this, he needed a different method to that of a day trader. First, one has to say that Livermore traded primarily in equities. There was no such thing as trading with an index at the time. However, you can apply this method perfectly in the usual trading markets, such as SP 500, NASDAQ, DAX, IBEX, CAC 40, or Euro US dollar. Before Livermore became active at all, he observed the markets. This is the first pillar of this method. Livermore was a good observer. Above all, he looked at the market leaders of that time, the driving forces of the stock markets. He studied the most important stocks of the sectors. In his time, these were, for example, Bethlehem Steel or Northern Pacific. Of course, today those would be stocks like Apple, Google, Amazon, or Facebook. He watched the behavior of those leaders. He looked at how they responded to certain news, whether they recovered quickly from a negative news announcement, bullish, or not, bearish. If you want to get involved with Livermore's method, you can refer to the little book by Richard D. Wyckoff, Jesse Livermore's Methods of Trading in Stocks. In my opinion, the key word here is observing. In other words, Livermore may have had no position in the market for weeks or even months. He was 100% in cash during those periods. That is not easy for many traders, because you have the feeling that if you have no position at all, you are not involved in the stock market, and you could miss out on good opportunities. Nothing could be farther from the truth. 100% cash is a position. Actually, it is a very important position. Before you can act, you first have to learn to observe closely and wait for the really good opportunities to come your way. Patience is one of the most important virtues that you will need to develop if you want to be successful with this method. It is undoubtedly the hardest part of the method. You will have to learn to transfer money to a brokerage account and then do nothing for weeks, sometimes even for months. Can you do this? Even if your broker bombards you with emails and asks you to start trading because his systems are sending him great signals. Again, you will have to learn from Livermore, who hated nothing more than the so-called tips that you get from everywhere as soon as you enter the stock market. He tried to free himself from these confusing influences by all the means he had at his disposal. He did this by partially isolating himself from the outside world, so that he was only able to listen to his own intuition and instincts. He did not become active until he saw a real opportunity, coming from his own observations. I think that this habit is much more difficult to learn today than it was in Livermore's day. Today, the news, opinions and tips, and whatever distractions the broker industry may invent, do not only come in the form of newspapers, magazines, newsletters, emails, and alerts. They also flash at you at the most inopportune moments, on the small, flat device that each of us carries around permanently, wherever we go. You must learn to forget about all that noise and disregard all the supposedly interesting stock market pages and the seemingly interesting articles by analysts. Or even better, do not even read them anymore. You must learn to become a completely independent observer and a completely independent-minded person. If you have acquired this important capacity of being able to ignore what others are saying, you will one day begin to perceive the signals from the market yourself. This is very important, because you cannot trade this method if you cannot observe and think on your own, and have therefore not formed your own opinion of the market. Did I just say that you should get your own opinion of the market? Yes, even though you may have read everywhere that you can only be a good trader if you have no opinion of the market. This may apply to short-term strategies such as day trading, but it does not apply if you want to make a trade, as I did with silver in 2008. At the end of 2007, due to the financial crisis, I was bullish on gold and silver, and the market proved me right. Will you always be right regarding the direction of the market? By no means. You will experience again and again that you have to close your first position at a loss, or that your position does not progress at all. You will experience that the market does not confirm your opinion. There's nothing wrong with that. That's part of the game. Hopefully you will get out of it with a small loss and return to the observation status for weeks or even months. After all, you want to respect the first law of a trader. Preserve your trading capital. Second, you always have to maintain another, even more important asset. And I do not mean the amount of money in your brokerage account. Your most important asset is your ability to think and observe independently. As long as you have a position and your money is exposed to market risks, you cannot think anymore. You are emotionally involved with the trade, and the bigger the position becomes, the more money there is in the game, the more you will battle with your feelings and emotions. If your emotions are so strong that you can hardly bear it, then your position is probably too big. If your emotions are so weak that you hardly feel them, then it is probably too small, and you should add to your position. It goes both ways. For example, I was one who tended to keep my positions too small. Therefore, my silver trade was a sort of cathartic moment for me, because it forced me to give it a go when the opportunity presented itself. One has to realize that making money on the stock market does not happen in the same way as it does in the usual professions. With a regular job, you get the same amount each month. That gives those who walk this path a sense of security. There is no such thing on the stock market. Oh well, some think that it is possible. Day trading, for example, is an attempt to reintroduce the security of an office job with regular income coming through the back door. On the stock market, there are only asymmetric earnings. What does that mean? Mostly, you do not earn anything, or you can even lose a bit. And then comes the day when the roast is served. These are the occasional opportunities where you can make a small fortune. Needless to say, these opportunities are only available to the trader who is prepared. And that is why it is so important to build your own independent observation post, as Jesse Livermore did. Then, if you see an opportunity based on your observations, you should buy, or sell if you go short, a small first position. This first position is to test the water. But the first position also has another important function. According to Livermore, you cannot judge a market until you are in it yourself. This first little position tells you whether or not you are in the right market. If you do not have a position, there is no way of knowing. You have to be emotionally involved with your own money. If the trade feels good and the market is moving in the right direction, you can start buying more contracts, or more shares if you trade in stocks. Of course, you will not catch a major trend every time, as I did with my silver trade. Sometimes you will have to interrupt the trade because the trend does not continue or even turns in the other direction. But if you follow the criteria that I will explain in the following chapters, you will occasionally make a nice profit. Chapter 4, Scaling In, Scaling Out. The real secret of a successful trading business is not the perfect entry or the perfect exit from a position. Too many traders put too much emphasis on this aspect of strategy. The real secret is ensuring that your winners are infinitely bigger than your losers. If you have a book profit with a trade, you should not frantically sell and pocket the profits, as many traders do. You should see this book gain as an opportunity or an option. You should ask yourself whether or not there is still a lot to gain here. So, the right strategy is to invest in this book profit. In principle, this trading technique can be carried out with any financial instrument. Of course, you will benefit most if you build such positions with leveraged instruments, such as features or options. You will learn to reinvest your unrealized gains on open trades. Put simply, you only buy additional contracts or stocks when the previous ones are already in profit. In this way, you can build up large positions in a market without increasing the initial risk of the position. The RRR, risk-reward ratio, will gradually improve in this way. However, if you do the opposite, averaging down, you increase your risk. Averaging down when prices fall further only makes sense for long-term oriented investors who, for example, have a dividend strategy. Right from the beginning, I would like to make it clear that the technique of buying up is easy to understand, but it is not necessarily easy to carry out. This technique goes against the nature of the trader. As soon as a trade becomes profitable, the trader wants to hedge it through active stop management or even pocket the gains. The trader must therefore muster a good deal of self-control and discipline in order not to concede to his natural tendency to take the first profits and run. On the contrary, instead of taking the profits and getting out of the market, he has to learn to buy additional contracts or shares. He has to learn to increase his position when the starting position is in profit. This requires courage, but also the insight to understand that this is the only way to reach substantial profits. The method that I present here is not the same as so-called pyramiding. It is important to clearly describe the difference. Building a pyramid in a market means that the first position you buy is the largest, the base of the pyramid. Each additional position you buy should be a bit smaller than the previous one, usually half the size. So, if you start with 100 shares, then the second position should only be 50 shares, the third, 25, and so on. The idea of this approach is clear. A trader who works with this methodology believes that the longer a trend lasts, the bigger the likelihood is that it will turn. That's why he reduces the risk. Although I can understand the logic of this methodology, it is a suboptimal idea for me. If you are right about your market assessment and the trend continues, then you should definitely go for it. Because if you are already sitting on good profits, you can, as already mentioned, speculate with the market's money. You should internalize this difference. Risk is not equal to risk. If you are a day trader and close your positions every night, you start afresh every morning. This means that you risk your money every day. In that sense, one could say that day trading is suboptimal in terms of risk management. Every day, you risk your money in the markets. By contrast, if you scale into a trend, you only risk your money with the first position. For the second contract, you pay with the market's money, with the book profits from the first position. Therefore, I am not talking about pyramiding, but about scaling in, scaling out. Unlike building a pyramid, you cannot increase your position until the first position has enough book profit, so that this book profit gain enables you to buy a second position. This second position is not smaller than the first. It is usually the same size. For example, if you trade futures, the smallest unit is one contract. You cannot reduce or divide this unit. In that sense, you double your position with the purchase of a second contract. If this one also runs into profit, the book profits of the first two contracts allow you to buy a third contract. From now on, you do not double your position, as you did with the second contract. Your position increases by 33%. The longer the trend lasts, and the more contracts you can buy, the smaller your risk will be, even though you substantially increase your position with each new purchase. Thus, with each new contract you buy, you greatly increase the chance of a huge win, while minimizing your risk, thanks to accumulated book profits. Therefore, in my view, scaling in, scaling out is a much less risky method than day trading, or even holding a stock portfolio that you have bought with 100% of your own funds. I hope the difference is clear. An intelligent investor tries to generate a maximum return with the lowest possible initial risk. This is the case with real estate. Here, the bank finances your property, and your tenant pays the installments. And this is how it should be when you buy a company or company shares through private placements, not by buying shares in the market. In my opinion, the method of scaling in, scaling out, therefore belongs in an advanced investor's toolbox. The first position is nothing more than a hypothesis, and this is really how you should see it. You make an assumption as to how a market might develop from the moment of purchase or sale on a short sale. This assumption is either confirmed or not. Basically, the output does not matter. Sometimes you'll be right, sometimes wrong. That's why you should not pyramid. Buy the largest position at the beginning, because you then buy the biggest position with your money. It is better to buy the larger portions of the position with the market's money, through book profits. Of course, the scaling in, scaling out method is not completely risk-free, because a medium or small reversal can reduce or even destroy the accrued book profit. Needless to say, if this happens, you should start to reduce your position and close it completely if necessary. Then it is a case of nothing ventured, nothing gained. Ideally, you should build a position in such a market so that this never happens. That's why I recommend that you do not use this method on medium trends, which take a few days, or even on short-term trends, a few hours. That's the common mistake many make. This method is designed for the major stock market trends. The idea is that you are in the trade for a matter of weeks and possibly several months. Only in this way, you can achieve above average profits, even with a small starting capital. This is hardly possible with the trends that only last a few days. The position takes time to develop. For example, if you buy a stock at USD 20, your goal should not be to sell it at USD 22. That's not a big trend. But if you hold on to the stock for 6 months and it rises to USD 35, then you have the time to build a significant position with it, which you finance with book profits. Scaling in, scaling out is not unusual, by the way. It is a common method used by many traders and also hedge funds to build significant positions in a market. However, if you have no previous experience with this method, I recommend that you start with a calm approach and do not buy too many contracts on the first trade. I will demonstrate how the technique works with 2 examples. See image 2, crude oil, scaling in, scaling out. As an example, let us have a closer look at this short trade in the crude oil futures. After the market gave a bearish signal, the trader went short with a first futures contract at USD 69.70, small red line in the upper left corner of the chart. As the market continued to fall, He sold at USD 66.4, a second contract short. Overall, he sold 7 contracts in this falling market. When crude oil hit the USD 50 mark in late November 2018, the future started to go sideways at that level. After not falling any further for a week, the trader was aware that a reversal or correction could happen and started scaling out. He bought back a first contract on the market, first green arrow on the bottom left. Thus, he was only 6 contracts short and had realized the profit of 1 contract. When the market stabilized above USD 50 after 3 days, he closed a second contract and a third contract 2 days later, so that he was only 4 contracts short. The trader was rewarded for his patience because on December 17th, crude oil fell below USD 50. When the futures fell below USD 47 the day after, he closed a 4th contract. Now he was only 3 contracts short. The low of this move was USD 42.72. Of course, the trader could not predict this low. As the future began to rise again in the following days, he gradually closed the 3 remaining contracts, green arrows on the right. Although the trader did not reach the optimum in this example, he nevertheless made a successful trade. He was in this move with 7 contracts short, all of which he was able to close at a profit. Overall, the trader was in the position from October 18th, 2018 to January 2nd, 2019, almost 2.5 months. This is a typical time frame for the type of position trade we are talking about here. Therefore, we are going to take a closer look at the trade and the development of the individual contracts. In this case, the trader traded the crude oil futures contract at the CME, code CL. The tick size, smallest price fluctuation, is USD 0.01 per barrel. The value of a tick is USD 10. The overnight margin of his American broker was USD 2,145. This means that the trader needed to have at least USD 2,145 in the account in order to trade a contract. However, he was able to go short with future contracts, thanks to the book profit of the first contracts. Contract 1, short, USD 69.7, flat, USD 53.5, profit, 1,620 ticks times USD 10 equals USD 16,200. Contract 2, short, USD 66.4, flat, USD 54.05, profit, 1,235 ticks times USD 10 equals USD 12,350. Contract 3, short, USD 64.20, flat, USD 52.1, profit, 1,210 ticks times USD 10 equals USD 12,100. Contract 4, short, USD 61.9, flat, USD 46.6, profit, 1,530 ticks times USD 10 equals USD 15,300. Contract 5, short, USD 59.7, flat, USD 45.9, profit, 1,380 ticks times USD 10 equals 13,800. Contract 6, short, USD 55.8, flat, USD 46.1, profit, 970 ticks times USD 10 equals 9,700. Contract 7, short, USD 52.2, flat, USD 47.5, profit, 470 ticks times USD 10 equals 4,700. Total, 8,415 ticks times USD 10 equals USD 84,150. If the trader had gone short with only 1 contract, for example, the first one, then his profit would have been USD 16,200. Certainly not bad, but I hope I could demonstrate the advantage of the scaling in method in this example, where a profit of USD 84,150 was recorded. In other words, the trader was able to realize a profit of USD 84,150 with a bet of USD 2,140, initial margin of the first contract. These are the trades I'm talking about, and they really help to grow your account substantially, and in many cases, your financial position too. That's why, in my opinion, it's worth waiting patiently for such opportunities. This example is a bit idealistic. Here, we were dealing with a market that was gradually going down, like a flight of stairs. Of course, this situation makes it easy for a trader to build a position step by step. He was also able to quietly scale out when the market reached. Normally, you would expect a proper reversal here, which forces the trader to close his positions quickly. Since this was not the case, the trader could benefit from another fall in the price of oil with the 4 remaining contracts. It should be clear to the reader that such an ideal case does not always occur. As a rule, if we are dealing with a real crisis market, things are a bit more chaotic. The next example illustrates such a situation. See image 3, natural gas future, 4-hour chart. In the example in image 3, the trader chose to trade the main contract on natural gas, NG, which is traded on the NYMEX. His American broker required an overnight margin of USD 2,420 per contract. If he had traded with a European broker, for example, he would have had to deposit USD 5,000 to trade even one contract. The smallest price fluctuation, tick, in this contract is 0.001. The value of a single tick is USD 10. After the future on natural gas had fluctuated between USD 2.50 and USD 3 for months in 2018, the price suddenly jumped above USD 3.20 on November 5th. This prompted the trader to open a first test position in this market, first green arrow at the bottom left. When the price rose to USD 3.40 the same day, the trader bought a second contract. On November 6th, the futures rose above USD 3.40, so the trader bought a third contract. It took until November 9th before the trader could buy again. The market went sideways for several days. From September 9th to 13th, the trader was able to buy 6 additional contracts. He was now long by 9 contracts. November 14th was the day when the future began to rise in a parabolic way. During the day, the future rose from USD 4 to over USD 4.80, an increase of 20%. As you can see, the trader bought 4 more contracts on the way up, but soon he had to start to scale out due to the insane volatility. In the afternoon and late evening of November 14th, the trader sold 9 of his 14 contracts. He closed the next 5 the next day at less favorable prices. His assumption that the future would continue to rise the next day, maybe even over USD 5, had not materialized, so he had to sell the rest of his position. Although the trader was far from selling at the high of this move in natural gas, he made a considerable profit. This trade only lasted 10 days, an unusually short period for this type of speculation.
Just taking a look at it. Guess we're waiting on the market structure on the 900.
That's exactly right, Quentin. That's exactly right. And then we'll take that trade. We sure will.
I got 2 contracts already selected. If you want me to just,
Yeah, that's good. We just needed to break this low. If we break this low, we're gonna be looking to get into the trade. It needs to break the low on this 900. Come on and break the low. Break the low. That's all I'm waiting on, what to break the low.
That sucks.
And it just takes off, doesn't it? Yeah, be more careful. Come on.
It needs to break. Yeah, it needs to. Don't take off on me right here. Got to form a market structure. Come on and form a market structure here, man. That was a good call there, Quinn. You did a good job on that one. Calling it. That was great.
It was clear as mud. Oh man, it's gonna slow down. What's up, you? Come on. There we go. Come on.
He gave you 2 1-bar pullbacks. Sheesh.
About to give us one more bar. One more. Come on down.
Yeah, this is. Just let me know if it broke the bottom. I'm not looking at it right this very second. Let me know if it breaks the bottom.
Where you got that cursor?
Ain't nothing you can do about that.
Dang.
Yeah, ain't nothing you can do about that, man.
Ain't nothing you can do about that, dog. Nothing. It's lining up too, but it just won't.
Couldn't we have got in right at 10 12:30, like 4, with that three? It looks like a red bar break.
Right, but that's not a market structure. You got to get a market structure. Market structure consists of 3 or more bars. You only had 2.
No, I'm talking about the 3 that I'm looking at. But anyway, hold on. Let's see what we got. No, down, further back. Further back.
Further, which way, left or right?
To the left, I'm sorry. Right in there.
Yeah, at that point, everything's not lined up the way you need it to because your 900 is still red.
You're right. And I see it. I see it. That's my question.
So
I see
that
it.
one right there just didn't give us a trade. It just ran without us.
Okay. And it's going gangbusters. Oh my gosh.
Yeah. That's crazy.
All right, then.
All right,
It's-
we're gonna go on. I'm gonna go on mute and wait on it.
I start the book back.
Yeah, thing.
B. The trader was able to buy more and more contracts on the way up, thanks to the book profits. Then, he had to scale out of his position relatively fast. In this case, within a few hours. It is important to take this into consideration when market volatility begins to increase disproportionately. In general, this is a sign that the movement is coming to an end. Let us take a closer look at the profits of the traded contracts here. Contract 1. Long. USD 3,200. Flat. USD 4,450. Profit. 1,250 ticks times USD 10 equals USD 12,500. Contract 2. Long. USD 3,400. Flat. USD 4,500. Profit. 1,100 ticks times USD 10 equals USD 11,000. Contract 3. Long. USD 3,430. Flat. USD 4,550. Profit. 1,120 ticks times USD 10 equals USD 11,200. Contract 4. Long. USD 3,550. Flat. USD 4,580. Profit. 1,030 ticks times USD 10 equals USD 10,300. Contract 5. Long. USD 3,600. Flat. USD 4,600. Profit. 1,000 ticks times USD 10 equals USD 10,000. Contract 6. Long. USD 3,650. Flat. USD 4,650. Profit. 1,000 ticks times USD 10 equals USD 10,000. Contract 7. Long. USD 3,800. Flat. USD 4,720. Profit. 920 ticks times USD 10 equals USD 9,200. Contract 8. Long. USD 3,870. Flat. USD 4,680. Profit. 810 ticks times USD 10 equals USD 8,100. Contract 9. Long. USD 3,950. Flat. USD 4,620. Profit. 1,000 ticks times USD 10 equals USD 10,000. Contract 10. Long. USD 4,000. Flat. USD 4,650. Profit. 670 ticks times USD 10 equals USD 6,700. Contract 11. Long. USD 4,100. Flat. USD 4,480. Profit. 380 ticks times USD 10 equals USD 3,800. Contract 12. Long. USD 4,200. Flat. USD 4,450. Profit. 250 ticks times USD 10 equals USD 2,500. Contract 13. Long. USD 4,300. Flat. USD 4,350. Profit. 50 ticks times USD 10 equals USD 500. Contract 14. Long. USD 4,450. Flat. USD 4,290. Loss. 160 ticks times USD 10 equals USD 1,600. Total. 10,420 ticks times USD 10 equals USD 104,200. As you can see, the trade was well worth it, even though the trader had to close one contract at a loss, contract 14. If you have to scale out fast, this can happen. It's important to keep in mind that prices may fluctuate wildly at the end of such a move. And although most of the profit is realized at the end, one should be aware of the corrections or reversals that could then occur. Chapter 5. Should you use stops? The biggest advantage of the scaling in, scaling out technique is to be found in the reduction of the initial risk. The trader who always trades with the same position size takes the same risk again and again. However, if you build up your position gradually, you will minimize the risk gradually too. At some point, it disappears completely. With the fourth or fifth contract, you will have built up so much book profit that you cannot lose anymore. While of course, every time you buy a new contract, you will have a market risk for that specific contract based on your trading capital. The accrued profit protects you from a new risk to your account. That's the fundamental difference that you should understand. And that's why this technique enables you far better risk management than you would have otherwise. Of course, you always have to be aware of a scenario in which an established trend suddenly turns and the market starts to move massively in the other direction. In that case, your contracts, which were profitable at first, suddenly start to lose. Depending on how many contracts or shares you currently hold, such a counter movement can quickly lead to significant losses. You will then receive margin calls from your broker. As soon as the first margin call comes in, you should not hesitate to start to scale out immediately. You may even need to close the full position, and you will then have to classify this speculation under the category failed attempts. Another way to reduce risk when the market goes in the wrong direction is to secure your positions with stops. Of course, if you've bought multiple contracts and you want to secure them all with stops, things will get a bit complicated. It is up to each trader whether he wants to use stops or not. In fact, when you work with stops, you basically are not building a single position. Rather, you have many individual trades side by side. You split your position into many small trades. There is nothing wrong with that, and I recommend that traders do it that way first. The question is, how you should do it. Because no matter which stop method you use, you will inevitably experience that a short-term correction will put contracts out of the market if you put your stops too close to the entry level. Despite this disadvantage, I recommend that beginners work this way to start with. You must first become familiar with this method and gain confidence, so that at a later stage, you can start to use more generous stops. A beginner using this technique can pull the stop of the first contract to break even as soon as he buys the second contract. He should do the same thing with the second contract, as soon as he buys the third, and so on. In this way, his maximum risk is equal to R1, or in other words, it is never bigger than his initial risk when he bought the first contract. This is a conservative approach, but it is clear and not open to any interpretation. A second option would be to work with trailing stops, which you could set for every single contract on the way. This gives you a bit more flexibility, and it also gives you a better chance to get the maximum out of the trade, which is the big advantage of a trailing stop. Unfortunately, with this method, you will experience that contracts are out of the market by reversals or counter movements, which of course is especially annoying if the trend continues thereafter. Of course, if a reversal takes 2 or 3 contracts out of the market, you can always buy them back later. But I only recommend that traders who are already familiar with the method do this. A more advanced method of risk management is to hedge the position. With this method, the trader takes the opposite trade at the same underlying basic value, or in a correlated instrument, in order to protect the account from major losses. As a rule, he should choose the same number of contracts that his position currently has. For example, if he has 5 contracts long in the euro-US dollar currency pair, he will hedge his position with 5 short positions in the same market. Should the euro-US dollar turn 180 degrees against his expectations, his stop-sell orders, short orders, will be executed gradually. Thus, he freezes his position, so to speak. In this way, the loss is limited. It results from the difference between the entry price of the long position and the entry price of the short position. It is important to know that not every Forex broker will allow you to hedge positions. Therefore, if you want to use hedging as a risk management tool, you should inquire with your broker in advance as to whether this is possible. Once the hedge has been built and the position is frozen, the trader has several options. He can close the full position, including the hedge, and thus take the loss. In general, this is the best solution. But he can also make partial closures and trade with a reduced position, should the market give him indications that it will develop in the desired direction again. Hedging is a complex topic, and experience has shown that it does not work for the majority of traders. For most traders, traditional stops are still the best solution. I see hedging more as a kind of emergency brake, which only comes into force when the position is really in danger, and bigger losses could occur. In my view, only traders who really know what they're doing should use hedging to protect open positions. Chapter 6. What do you do if the market is going in the wrong direction? No matter how well you prepare trades, you will experience, from time to time, that a position that you currently hold does not work out as desired. Perhaps it is not moving at all, and your test position changes from slightly in the plus to slightly in the minus. Of course, this is the easy version. You can either close the position and wait until something really starts happening, or the second option is to push the stop closer to your entry price in the hope that the market will eventually begin to move properly. Usually you will be stopped out. It is a well-known trader's wisdom that positions that go into profit immediately are usually the best. If they do not, always be careful. On the other hand, if your position initially goes in the right direction, and you are already able to buy 3 or 4 contracts, and then the market suddenly turns 180 degrees, you should not panic. Emotions such as panic are an unmistakable sign that either your position is too big or that this method does not suit you. If the market goes against you for a few hours a day and the losses become too big, instead of hurrying to close the whole position, you can close a part of your position. For example, you could sell the last 2 contracts you bought that are now at a loss, and then watch the market until it turns back in your favor. The big advantage of multiple entries is that you do not need to close the whole position when things are not going well. If you only have 1 contract, it goes without saying that you have to get out completely. When you start working with the scaling in, scaling out method, you will automatically learn to become an active manager of your positions. This technique is based on the insight that the ideal entry into a position does not usually happen. As a rule, you will need to be patient and give your first position time to become profitable. Incidentally, not all trend markets develop in a straight line, in one direction. That's why I recommend trading on higher time frames, such as daily charts or even weekly charts. If your position is showing a decent profit and you have 4 or 5 contracts in the market, then you do not necessarily have to sell when the market goes against you for a few days. Admittedly, This scenario causes stress for some traders, but you should be able to withstand it if you want to become a millionaire. The only real risk is the loss of your initial capital. You should act when the first margin calls come in, at the latest. As each market evolves differently, there can be no blueprint for building positions. It's up to you to decide whether your position is simply too big, or maybe too small. Your task as the manager of your account is to generate the maximum return with the minimum risk. If you only minimize your risks and do not buy enough contracts if the trade is going well, you violate the second part of this rule. Then you behave like those traders who trade with a linear position management. The whole strength of the method I recommend here is to understand that stock market success has little to do with hit rates or exact entries. You will have success in trading if you understand that profits come in asymmetrically. If you are on the right track, your position should be big enough for you to benefit disproportionately. Your trading history might look like this: minus 270, minus 1,745, plus 200, minus 2,340, plus 14,230, minus 3,140, plus 490, minus 1,300, minus 2,580, plus 45,360, minus 378, minus 1,700, and so on. I hope you understand the idea. The monster profits will only happen if you learn to buy consistently when you are on the right track. Chapter 7. Go Global Macro. Since I recommend that traders should use this method to observe the developments on the global markets, we should also look at the strategy that bears this name, the Global Macro Strategy. This is a hedge fund strategy based on the macroeconomic principles of different countries or regions. For example, if the fund manager believes that the Eurozone is going into recession, he could sell short stocks or stock indices of the Eurozone. He has all the tools the financial sector has to offer at his disposal: stocks, futures, options, currencies, forwards, bonds, or ETFs. Global macro funds thus build positions based on events or shifts in international financial markets worldwide. One of the most famous global macro trades was the bet George Soros made against the British pound in 1992. By the way, I do not share Soros's political views, but I admire him as a trader. Soros then assumed that Great Britain would leave the European monetary system. According to his analysis, in the UK, both inflation and the key interest rate were too high, which had a negative impact on the British economy. His fund then built up a short position of $10 billion in the British pound over the course of several months. For the time, this was a huge position, even for a professional hedge fund. As you might know, Soros does not fiddle about on the edge. His strokes are broad. In the end, the UK had to give in and leave the European monetary system overnight. The pound depreciated dramatically. Soros's profit was over $1 billion, the biggest gain a trader had ever made on a single trade till then. Global macro traders have a clear justification for their trades. Now, such an approach sounds like you should have at least a degree in economics, or a whole division of specialists who provide in-depth analyses of developments in the financial markets, from which the trader can pick out the cream of the crop. The truth is that the managers of these funds know just as little as you. Maybe they have access to more data than you do. Maybe they are a bit smarter. I'm not convinced about that. But the fact is that these people are just as worried about whether the price of oil is likely to rise or not, or whether the UK will leave the EU or not, or whether President Trump will win the next election or not, and what this could mean to the dollar. You actually have an advantage over these specialists. You are not accountable to any customers or investors when it comes to your trading decisions. Customers can always threaten to withdraw their money if you do not perform well, and that can cost you your job. You do not have any of those problems. You can simply speculate fearlessly. The only thing you are risking is the money in your account. And with regard to the information that is available, we have much too much of it these days. The internet is full of news, analyses, and opinions from so-called specialists. I specialize in crises. The reason for this is simple. At some point, you will hear about it, be it in the news or on one of your financial blogs on the internet. Crises occur again and again, and sometimes they have long lead times that give you all the time in the world to find out and build initial positions. When Greece skidded in 2010, the country was on the news every night, at least in Europe. And you should not make it too complicated. If there's a crisis somewhere, your options are limited anyway. Do you want to go short in the currency of the country? Or do you prefer to short sell its most important stock index? Or both? Whether or not you have detailed statistics and data on the country's problems is not going to make your decision-making process easier. On the contrary, it is more likely to paralyze you and maybe even prevent you from doing the trade at all. Surely until now, nobody has become poor this way, but neither has it made anyone rich. Put simply, you will have to learn to be a speculator who acts internationally, despite limited information. Perhaps an awkward speculator in the beginning, but with increasing experience, you will become a more experienced speculator. And who knows, at some point, you might even become as shrewd as Soros, Rogers, or Paulson. Chapter 8. Look at the big picture. I'm always amazed at how little interest traders show in historical charts. If your main activity is the 5-minute chart, why look at a daily chart, let alone a weekly chart of your market? But if you want to bet on bigger trends, then you should do just that. Study long-term charts. You can find these charts on special websites, such as finviz.com. The nice thing about this site is the overview that it gives you across all markets at a glance. Just click on futures and then on charts. You can see which markets are currently in an uptrend or a downtrend and which ones are going sideways. FinViz lists the most important indices, commodities, bonds, and currencies. It is enough if you visit this site once a week and are aware of what is going on in the markets right now. Now, you may be wondering if it is absolutely necessary to study the price history of a market, not just for the last 2 or 5 years, but if available, also for the last 20 or 30 years, as some traders do. I know a Dutch investor who goes back even further in time. He once invited me to his home because he knew I was involved in the stock market. After chatting over a good cup of coffee, he invited me into an adjoining room, decorated with old maps, with a large oak table in the middle. He asked me to sit down, and then he suddenly took several large, elongated notebooks out of a cupboard and placed them on the oak table in front of me. As it turned out, he had compiled these books himself with the utmost care. There's only one copy of these in the world, he said. I was not quite sure whether he was joking or if he had spoken with an ironic undertone. Anyway, I was amazed when I started leafing through one of the notebooks. Each sheet represented the historical price history of a market. He had the Dow Jones, the Dutch AEX. He had bonds, commodities, and currencies. It was really fascinating because some of his charts went back over 300 years in time. This trader knew, for example, what the price of wheat was at the time of the French Revolution. He knew the price of coffee when the first coffee houses were opened in London and Paris in the 17th century. For gold and silver, he needed 2 pages because these charts went back over 800 years. It was fascinating to see what this trader had put together in the most laborious work. He had this information from a particular person who specializes in the presentation of such long-term charts. You may be wondering how it is possible to have such chart histories, especially since the habit of grouping stocks together in an index did not materialize until the end of the 19th century, when Charles Dow invented the Dow Jones Index. This was done by collecting the most important stock data before the index was introduced, thus calculating the Dow Jones backwards. At first, I thought that his hobby, as he called it, was in fact a leisure activity. Because what does it matter if you know today what a theoretical, recalculated, dollar price was at the time of the American War of Independence? The Dutch investor seemed to take it all very seriously. The Dutch, as we know, invented the stock market. And the more I talked to him about this or that historical development in certain markets, the more I got the impression that he actually used his charts to speculate, Of course, such calculations should be treated with some caution. As I flipped through his notebooks, he repeatedly pointed to one spot or another in an index or commodity chart, and I said, I think it will take us another 4 or 5 years to reach that level. Then it will become interesting. I could see a little twinkle in his eyes at the thought. He left no doubt. He had the patience to wait 4 or 5 years before investing in this market or that. Of course, you do not need to do your historical research as extensively as this Dutch investor did. But I was a bit jealous of his method. He has perspective, I thought. I could imagine him sitting at his oak table every now and then, leaning over his charts, and maybe thinking, okay, let us wait 2 more years before we do anything here. I learned 2 things from this man. First, patience. Not only had he printed his charts, highly recommended, but he kept them like art books so that he could look at them with the necessary respect and distance in order to think about their development. This Sunday perspective gives him the necessary distance to look at something in peace. This is hardly possible on a screen. The price fantasy that offers such a long-term perspective is even more important. If you look at Dow Jones' hourly chart, a perspective my Dutch stock market friend could only laugh at. How much price fantasy do you have? 500 points? 1,000? This Dutch trader considered a Dow Jones of 25,000 points, merely as an intermediate step on the way to 100,000 points. When I was with him, the Dow stood at 9,000, I think. Because of his historical view, he had this price fantasy. He could not tell me exactly whether we would reach the 100,000 in 2040 or 2045, but he was pretty sure it would happen in about that period. I am telling you this story because it shows that without such price fantasies, you cannot become a successful speculator. You have to take a bird's eye view and forget the daily back and forth on the stock market. All of this is just noise, and it happens to confuse you. To speculate, you need a clear mind and a perspective that deals more with weekly and monthly charts of a market than with hourly charts, or even shorter time units. If you want to know where the money in the stock market is, that is where you will find it, in the weekly and monthly charts. And if you're looking for clear entry or exit signals, I recommend using Heiken Ashi charts whenever possible, because they also filter the daily noise out of a chart. Here are some examples. See Image 4, USD, CAD, weekly chart 2014 through 2016. Look at this weekly chart of the US dollar/Canadian dollar currency pair. Each candle represents 1 week of trading. I think the trend on this chart is clear. As soon as the color changes, you can close the position or even trade in the opposite direction. If the color changes again, you should also close or change your position. Is it that easy? Yes, it is. See Image 5, Amazon, weekly chart, 2015 through 2018. This weekly chart of the Amazon share may be even clearer. Sure, Amazon was in a clear upward trend during this period, but look how easily the Heiken Ashi candles could have helped you to build significant positions in such a market. See Image 6, Apple, weekly chart. Or, a current example, in the last quarter of 2018, Apple stock made a serious downward move, black Heiken Ashi candles. But then, after a doji arose, the perfect entry signal for a long position came in January 2019. Chapter 9, Look for a Catalyst. Of course, you can go along with the trend, according to the examples in the previous chapter, but then you will actually be a trend follower. There's nothing wrong with that, but please do it with the market leaders. In other words, with the shares that are also being bought by the big funds. Then you have a good chance that your speculation will work out. However, in the past, I often got really good results when I found a market that started moving because of a fundamental change. What else should move a market, if not some dramatic news, a positive or a negative? In order for you to speculate on such a dimension, you need a catalyst. What do I mean by that? A catalyst is an event or development in a market that fundamentally changes the perception of the players involved. So, This is not a message that is going to push the price up or down a few percent in the short term. Not even a negative outlook or the downgrading of an analyst firm is enough to fundamentally change the perception of a company. Even sudden news, for example, a market approval of a drug in a biopharmaceutical company, will hardly help you. Price gap after news like this. Thus, the news is already factored into the price. Of course, the stock might continue to rise, but there are no guarantees. The same applies to surprisingly negative corporate news. Here, the stock opens with a discount down. Thus, the bad news is also factored in. All these events are hard to predict and even harder to trade, unless you trade the technical counter movement. I described how to do that in my book, Trade Against the Trend. Short-term or unexpected news does not really help you when speculating on big trends. That's why you can confidently disregard them. The same is true for surprising results of elections or referendums, as was the case with the Brexit. If on the eve of such an event, you take a long or short position on the British pound, this is like gambling. You cannot really speculate on dramatic events, such as the Frankageddon, red arrow on the left in the chart. That incident took just 25 minutes, and no one, or hardly anyone, expected it, especially as the Swiss National Bank had publicly announced a few days earlier that it would stick to the euro Swiss franc peg of 1.20. Even central banks are run by human beings, and as you can see, they change their minds anytime. See image 7, euro Swiss franc, weekly chart, Heiken Ashi, 2014 through 2018. Of course, as an investor, you could have gradually built up a long euro Swiss franc position after the dust had settled in the Swiss franc debacle. It was safe to assume that the market had overreacted and that it would correct the exaggeration. The euro Swiss franc plunged from 1.20 to 0.96 within 25 minutes. This actually did happen, and the euro Swiss franc actually reached exactly the lower edge of the former SNB peg, black arrow top right in the chart. However, the pair needed 3 years to do so. This violates our rule of wanting to grow our account fast. Such investments are interesting, but they usually take more time. Anyone who knows me a bit knows that despite all the information available on the internet, I still like to read the newspaper. One may think that I'm old-fashioned or a bit eccentric. Let me briefly explain the reason why I cling to this habit. For the younger readers, a newspaper is an information medium printed on light paper that is usually found hanging on a hook in good cafes. When reading newspapers, the speculator should learn to filter out the messages that are important to him. Of course, that's easier said than done. The old Hungarian speculator, Andrei Kostalani, whom I refer to here, taught that one should learn to read between the lines. He meant that the actual news in itself is usually not interesting, because it is in the newspapers at the moment, so everyone knows about it. When reading an article, a column, an opinion, or a commentary, you should pay attention to certain remarks or asides, because they may contain interesting information that you may have overlooked by merely skimming over the news. And that's why I actually recommend going to the coffee house every now and then and grabbing an old-fashioned medium like a newspaper, because you still need to bring in that necessary element of unhurriedness in order to even acknowledge such information. Unfortunately, you cannot smoke cigars in most cafes anymore, a weak-minded decision in my eyes, because that would slow down your reading pace even more. If I have the time to do this on my terrace at home on weekends, I often find that kind of information, small comments, or interesting asides that grab my attention as a speculator. It's exactly these remarks that can get a thought process going. For example, the question might be, what effect could this event have on this market or that one? As a current example, February 2019, the so-called Dieselgate could apply. Several car manufacturers, especially Volkswagen, had carried out illegal manipulations in order to circumvent the statutory limits of car exhaust emissions. That's the news. Now, as a speculator, it is your job to think about what such an event might mean for the stock market. Of course, the immediate thought is to short sell the shares of the affected car manufacturers. The main candidate here was the German stock of Volkswagen, which was one of the main players in the scandal. However, if you look at the chart for this stock, you immediately realize that the news was factored in by the market within a very short time. The stock fell from euro 168 to euro 105 on the Frankfurt Stock Exchange in just 3 days. So here too, the actual news doesn't help you much. The stock market reacts immediately, and only smart day traders are able to benefit from such an event. Volkswagen stock was therefore not of much value in terms of speculating on the diesel scandal. As Castellani aptly said, if you only read the headlines or the mostly boring annual reports, you will usually only learn what everyone already knows. So, in connection with an event of such a dimension, you need to dig a little deeper if you want to find an idea that is interesting to speculate on. And indeed, in the months after Dieselgate hit the news, there was an indirect profiteer. As this scandal gradually made it clear that diesel vehicles had fallen out of favor, there had to be other vehicle technology that would benefit. At first, of course, one thinks of electric vehicles, but that is still a very young market. Those who thought logically came to the conclusion that initially, more gasoline cars would be purchased. The increased demand for gasoline cars eventually had consequences for the precious metal palladium, which is needed for the catalytic converters. Gasoline emissions are cleaned with palladium catalytic converters, and diesel emissions with platinum catalytic converters. Since the emissions regulations worldwide, but especially in China, had become more stringent, they required a higher proportion of palladium per catalytic converters. The results can be seen in the palladium chart. The arrow marks September 2015, when the Dieselgate news broke. As you can see, it took some time for the market to change, but gradually, the insight prevailed among the market players that a fundamental change had taken place. Investors also had plenty of time to position themselves in the market. You see, the new upward trend in palladium only became noticeable gradually. In this case, the catalyst for a stock market trend was literally the catalytic converter. See image 8, palladium, 2015 through 2019. For comparison, the chart of platinum in the same period. See image 9, platinum, 2015, 2019. So you need a catalyst, an event that moves or fundamentally realigns a market for a while, as was the case with palladium. Of course, the catalyst can also be politically motivated. For example, when presidential elections in the USA are imminent, American presidents or presidential candidates tend to be classed as stock market friendly or stock market unfriendly. In the run-up to such elections, the stock market can rise in the hope that the desired candidate for investors will win. But even after the elections, the stock market can rise. This happened, for example, in November 2016, when, much to the surprise of many, Donald Trump moved into the White House. Since this was not expected by most analysts, they suddenly remembered Trump's attractive election promises for investors, such as generous tax cuts and all sorts of deregulation. The election results were followed by a veritable Trump rally in US stocks. Wars can also become a catalyst. As the stock market anticipates future events, it often reacts or overreacts in the run-up to the expected event. This was the case in the weeks leading up to the Second Iraq War in early 2003. The threats and the rattling of sabers in the media caused prices to tumble to the bottom. When the war began, as the first bombs fell on Baghdad, the stock market considered the matter to be over and done with, and it began to rise up again. This phenomenon can be observed again and again. Even in the run-up to the Second World War, it was no different. When the threat of war was imminent in 1939, the stock market fell. As soon as World War II began, stocks began to rise again. This phenomenon is described by the French term fait accompli, In English, accomplished fact. This moment occurs when all relevant news is factored into the price. Why is that? Basically, speculation can only be based on a future event, so on something that might happen in the near or distant future. Therefore, a savvy speculator should direct his attention to the markets in which a future event is expected, hoped for, or even feared. If all the news has been factored into the prices, and no further news is expected for the time being, what remains that can move the prices? And of course, the more dramatic the event is, or is likely to be, the more the prices will be exaggerated, until the market surrenders completely, down, as in 2008 financial crisis, or skyrockets, as if there is no tomorrow. See Bitcoin 2017. There is no need to explain that the most money can be made in such markets. The events do not always have to be so dramatic. If investors expect a company to deliver excellent quarterly results, they will buy the company's stock in advance. In general, this is a good opportunity for a speculation that lasts a few weeks. This method works particularly well with the current market leaders, i.e., the Apples, Alphabets, Facebooks, and Amazons of this world as of 2019. The speculator should close his position the day before the quarterly numbers come out. Quite often, investors will sell the stock on the day of publication, even if the results meet investors' expectations, or for that very reason, fait accompli. Of course, the opposite also happens. If investors are pessimistic about the numbers, they sell the stock ahead of the release. If the numbers are better, or less dramatic, than expected, this news must be factored into the price. Often, the stock then jumps and goes up for a few days. Such an event is rather less suitable for the method mentioned here, but it can be a good opportunity for short-term oriented traders. The phenomenon can also be observed with regard to announcements by the central banks. If a central bank chief announces that he is going to raise rates, and this event is widely anticipated by market players, a multi-week rally will often start, even though interest rate hikes are generally negative for stocks. Here too, fait accompli. If everyone knows that the central bank is going to raise the interest rates, then this negative news for equities is already factored into the price. So stock prices can go up again. As you see, the stock market has its own logic that you need to study if you want to be successful. Why is the interest rate so important to the stock market? The increase in interest rates affects monetary growth, and the money factor is the oxygen that keeps the stock market alive. When the world's major central banks cut their key interest rates to almost 0% in the wake of the financial crisis, money became cheap and sought ways to be invested. Therefore, in the years following this measure, people were building houses like crazy with all this cheap money, and a lot of money was invested in stocks, because with the dividends, you could at least make a small profit. Chapter 10, Mistakes to Learn From. After my silver trade, I wanted to repeat my coup. I will be honest. Since the success, I have made several mistakes, which I do not want to conceal from you. I speak of them here, so that the reader can learn from them, and hopefully not repeat them. I am not ashamed to have made these mistakes, though I am still a bit angry about them today. But I hope that the trouble will be the fuel that ensures I'm on the right side when the next opportunity comes around the corner. Even though the events of that time, 2008 financial crisis, occurred more than 10 years ago, it is still interesting to recall them. The mood at the time was so bad that I assumed that every correction in gold and silver was an opportunity to buy. Not even close. After silver had reached a high in early March 2008, it fell continuously during the course of 2008. I bought silver again and again, and I had to close my positions at a loss each time. The result was that at some point, I no longer dared to buy silver. And then the inevitable happened. Silver bottomed out at USD 9 at the end of 2008, and then it began to rise again in December. I was so annoyed by my losses that I did not dare to buy. A big mistake, as I found out later, because December 2008 was the starting signal of one of the largest bull markets in silver ever. Silver rose from USD 10 to almost USD 50 in just over 2 years, more than a five-fold increase. Although I traded in silver in this period, I was never really able to benefit from this megatrend and all that, even though I was able to take a good deal of the upward movement in 2007, 2008. But the subsequent movement in silver was 10 times as big. You can figure out what I could have earned in such a market. See image 10, silver 2006 through 2019, monthly chart. As if all that had not been enough, I tried to go long in silver after it had achieved its high in April 2011. You can clearly see in the chart how successful I was with this.
I gotta pause for a minute, guys.
Okay, man, I got you.
that I did not see anything else. I thought the whole financial world was in a kind of permanent crisis after the so-called financial crisis of 2008. So investing in gold and silver must be worth it. Not even close. The bull market in silver was over, and the only right thing to do would have been to take a short position. But I could not think that far at the time. I was fixated on crisis. So silver and gold long. A big mistake. The lesson I learned from this sounds simple. If you have had a big success in a market, it is best not to trade that market for a while, no matter what else happens. As a rule, you will take the wrong position the second time around and lose money. The reason is simple. Emotionally, you are too dependent on this market. It has been good to you and has given you a decent profit. At the moment, in my experience, the most dangerous thing is to re-enter. It is better to look for an opportunity in another market. See image 11, Dow Jones 2007 through 2019, monthly chart. As if this amateurish thing was not enough, I tried my luck in the stock markets in the months that followed. They had recovered well after the crash of 2008. In 2011, the Dow Jones had almost made up for the losses of the financial crisis. The stock markets had been rising for 2 years, influenced by the euro crisis, which was also the cause of the big rise in gold and silver. I was still in crisis mode. I did not go long in the stock indices. I went short. I thought this recovery would be a mistake. Meanwhile, the central banks had lowered interest rates to 0. So, I should have known that investors could not make any money with government bonds. No capital going to fixed income usually means that it will seek other assets that at least bring some returns. And what could be more obvious than simply buying stocks and earning dividends? And so it happened. We have been in this bull market since March 2009, as of May 2019. The charts also show it unmistakably, especially the charts of the American stock indices. But instead of going long and just buying the trend and making serious money, I went short. What a mistake. I'm telling you this because these stupidities are not that unusual. Sometimes it is really hard to just do the obvious thing. From 2009 to 2019, we had one of the biggest bull markets in stocks history. So we had 10 years to go long and make money. Over the years, countless crash profits have called for the end of this bull market. It's not possible. It's all bought on credit. This is a central bank rally that has no substance. You can expand the list of reasons as to why you should not buy any shares during this time indefinitely. There was a good reason why Jesse Livermore tried, by all means available, to block his ears, especially to analysts. All those tips and the people who think they know it all. Nobody knows anything. This has to be clear. Like Livermore, I recommend that you listen to nobody, and that you certainly do not waste your time with endless analyses and opinions. That is hard. I did not follow my own advice, and that cost me a lot of money. Believe what you see, and not the opinions of the others. It is better to watch the developments of the long-term charts. If a stock index has been rising for 2 years, and it continues to rise, is there any reason to go short? Chapter 11. Success with cotton. I was unable to benefit from the bull market in silver in 2011, but I succeeded with another speculation, which corresponded better to my skeptical nature. Hence the following story. A friend of mine, who lived in Berlin at that time, had a small textile company, with its production site in a small town in the federal state of Brandenburg, in the east of Germany. This fact alone amazed me, because in 2010, there were not many textile companies that were able to produce in any of the former East German states, with their high unemployment figures. Rather, one would have expected the production sites to be in countries like Bangladesh. My friend's company made industrial textiles, mostly workwear for hospitals. It was a niche in which she managed to assert herself over the years, with the help of a loyal team. I really admired her for this achievement, engaging people in that weak economic environment by making clothes. Hats off. We met for a cup of coffee, and I remember that we also talked about her company from time to time. At the end of 2010, she called me, asking if I had time to talk. She knew that I was involved in the stock market. She sounded restless on the phone. When I met her a day later, she looked very worried. At first, I thought that her company had run out of clients and that she would have to dismiss employees. That had happened in the past. It turned out, however, that her concern was quite different. I have several sales orders, she said, but I cannot deliver. Why? I asked. Normally you always deliver punctually. Yes, she said. That's not the problem. I cannot get any cotton. We're desperately waiting for a delivery, but it's just not coming. So we cannot produce. No cotton, I said. How can that be? Cotton is as plentiful as sand on the beach. I thought it was. She put on her worried face again, and then she began to inform me about what was going on in the cotton market. Apparently, there was a big shortage of cotton. Apparently, when she started to explain the situation to me, I got a little lesson in the world of raw materials. All around the world, cotton is harvested during different seasons. Then it is produced and transported to the spinning mills. And that year, there was a weak harvest in the important production country, Pakistan. Demand had grown steadily in the previous years, especially China, with its hot economy, was hungry for all kinds of commodities, including cotton. In addition, there were export restrictions. And as if that was not enough, producers in Pakistan and India began to hoard their supplies due to steadily rising prices. They simply are not handing over the cotton anymore, my friend said in a desperate tone. They would rather fill their warehouses in the hope that prices will rise even further. The situation is desperate. In fact, the price of cotton on the Intercontinental Exchange.
Q, go ahead and pause it for a second. We're gonna talk here for a minute. Want to get some dialogue to everybody. Today, ladies and gentlemen, there were no trades taken on the YouTube live. I'm really disappointed in that fact, but it wasn't anything we can do. And let me tell you why. There were 3 trades. 2 of them happened so fast by the way we trade that there was nothing you could have done. I mean, we could have got into the trade and it would have worked, but we would have had to take a 3 to 6 point slippage on the trade because it was moving that fast today. And then the loan, it gave us the setup, but it didn't give us an entry. Okay. So there ain't nothing you can do about that. You just have to wait. But the biggest thing is to be disciplined and wait on what you want to see. Right. The biggest thing that you're going to ever get from me is trading is going to be here. Worrying about one trade is a waste of imagination. One trade is not going to make you a millionaire, and one trade is not going to make you bankrupt, or at least it shouldn't. Your ability to make money over a plethora of trades shows your soul in trading. So that being said,
Can I say something?
yeah, absolutely, man.
And I just want to say to the audience that, we are up for the week nicely, and what we're doing is protecting profit or managing. You can make trades, but you got to make sure you protect profit when you have it, and just don't make a decision because you want to get a trade in. So I appreciate you, Dr. Jones, for just kind of helping us to see that, because at the end of the day, we're here to make money, not lose it. And I understand we will have opportunities, or not opportunities. There will be times when you lose, but your losers should be smaller than your winners. Your winners should be exponentially bigger.
That is correct. That is correct. So, ladies and gentlemen, we're not going to hold anybody here. Please give feedback. Let me know what you think. But see you on the other side. We will do a class a little bit. I mean, this before this week is over with, and I'll put it out to everybody. So on that note, we're out, ladies and gentlemen.